I don't know if there's a right place.
Thank you for coming. We appreciate your attendance. I hope you enjoy today's talk. For those of you who don't know me, my name is Mark Schreiner. I'm currently a student in the MSF program. I'll be graduating in a few weeks. My partner here is Jeremy Bayless. He's an undergraduate finance major who was recently admitted to the MSF class of 2010.
There you go.
Our visiting lecturer for the Capitalism course and the man whose interest sparked today's event is Bruce Foerster over here. Bruce has had a long, distinguished career with various financial institutions in the United States Navy. He also is the Associate Director of Placements for the MSF program, so he'll help you out with anything from industry advice to strategies for interviews, pretty much anything you can think of. So all you younger guys and girls, I recommend you get to know him. Jeremy and I, we won the lottery for our class, so we were able to put together this case. It's pretty interesting. It's about the Tribune Company, their acquisition of Times Mirror, and some of the issues they were facing during a pretty interesting time in the newspaper industry. That leads us to our guest speakers here, who both have a significant experience and knowledge of today's topic. Starting with John Carroll. John is he pretty much lived through the acquisition of Times Mirror. He was the editor of the LA Times from 2000 to 2005 and was the editor of the Baltimore Sun for 10 years prior. In all, he has over 25 years experience being an editor of paper, and he's also served as a reporter in Vietnam, Middle East, and Washington, I believe. Next, we have Norman Pearlstine. Norman is currently the senior advisor to Carlyle Group's Media and Telecom Group. He also spent over a decade as editor-in-chief of Time Inc., where he oversaw the content of Time's 154 magazines, I believe. So he also spent some time working for the Wall Street Journal in Asia, Europe, and the U.S. He has some pretty interesting experience because with his position at Carlyle, he's been able to oversee the books of pretty much all the deals that have gone down in the past few years, or the potential deals that might have failed. So other than that, I guess I want to thank Dr. Brown for helping us put this together, marketing the event. And we don't have a scheduled break. It's going to go a little bit longer than usual, so if you have to get up, feel free to. Just please do so quietly. And as our group's class rules, please don't speak to anybody around you during the presentation, and so no laptops open. I don't think I've seen anything. So I'll hand it over to Jeremy.
Thank you very much, Mark, for the introduction. And now a little brief history on the Tribune Company. The Tribune Company was established in 1847, was based in Chicago, Illinois. It was a family-owned company started by Joseph Medill and continued on with his family and grandchildren. In 1983, after 136 years of private ownership, the Tribune Company became a public company with initial offering of 7.7 million shares, valued at $206 million. The opening price per share was $26.75, and the IPO was one of the largest during that time period. The company performed extremely well during the mid-1980s due to several key acquisitions. The most significant purchase happened in 1985 with KTLA TV in Los Angeles for over $500 million. This acquisition made the Tribune Company the first and only non-network company to own television stations in the country's top 3 markets, New York, Chicago, and LA. During the 1990s, the Tribune Company began to grow considerably due to a loosening of federal regulations by the Federal Communications Commission that restricted television and radio ownership. During this time period, rapid consolidation was occurring within the broadcasting industry. The Tribune Company played a significant role in consolidation and eventually emerged as one of the largest owners and operators of newspapers, radio stations, and television stations across the country. The most significant acquisition that the Tribune Company had ever made occurred in March of 2000. The Tribune Company bought Times Mirror Company for $8.3 billion. This was the largest acquisition in the history of the newspaper industry. The combined company would become a coast-to-coast media conglomerate that ranked 3rd in circulation after Gannett and Knight Ridder. Adding Times Mirror to its business allowed the Tribune Company to insert 7 daily newspapers to the Tribune fold, headlined by Los Angeles Times, Newsday, the Baltimore Sun, and the Hartford Courant. The Tribune Company also held positions in Spanish-language newspapers in markets that had large Hispanic populations. Other advantages from the merger include various economies of scale that would assist the Tribune Company in its attempt to compete for national advertising. The purchase of Times-Mirror may have seemed questionable in a changing newspaper environment, but the Tribune Company was struggling to improve circulation and maintain the advertising revenues that drove their financial performance. Revenues are one of the key measures that many executives speak of when comparing their company to competitors. The Times-Mirror deal increased revenue significantly for the Tribune Company. However, net income did not experience a large increase and had many extremely low years. It is apparent that although the company saw improvement in revenues, the more important financial figures, net income and return on equity, were not enhanced. In mid-2006, the Tribune Company decided to put itself up for auction. There was a lot of pressure from stockholders, including the Chandler family, to sell parts or all of its assets due to falling stock prices and earnings. Even with all the great accomplishments and Pulitzer Prizes the Tribune Company was winning, their stock prices, along with the rest of the newspaper industry, were falling. In April 2007, the Tribune Company let it be known that they had sold the company to billionaire and real estate entrepreneur Sam Zell for $8.2 billion. Zell plans on converting the public company into a private S corporation, thus making its sole ownership an employee stock ownership plan. Sam Zell is known as the grave dancer for his flair of picking up distressed properties and turning them into profitable enterprises. The real reason for Zell's purchase of the Tribune Company is not known, but Sam Zell has assured everyone that his goal is to provide a sustainable, relevant product for his customers and communities. And now let us welcome Norm Pearlstine to the podium.
Thank you. Thanks very much, and thank you for that summary. I'm going to just start with a few minutes of historical background and then turn things over to John, who's going to speak more specifically about the actual merger of the two big companies here. My hope is that as the morning evolves, our session becomes much more of a discussion rather than of our giving speeches here, and I look forward to you really directing where we go with this conversation in terms of the kinds of things that interest you. But I think in thinking about what was going on at Tribune as it grew from that paper in Chicago into this very large enterprise, it's worth really stepping back a second and thinking generally about where the newspaper was coming from. And you really, in many ways, have to go back initially to did I just do that? If so, I'm not quite sure how to undo it, so maybe someone could bring it back. Newspapers really started out as very small businesses. In the United States, at the time when the Constitution was established and the First Amendment was passed for guaranteeing freedom of the press, nobody was thinking about large multimedia corporations with cross-platforms in radio and the internet and newspapers and television. They were talking about what you might typically call the lonely pamphleteer, somebody who was putting out a 2 or 4 sheet publication, lots of opinion, maybe a little bit of reporting, often scurrilous, sometimes pornographic, often very critical of government or of institutions or of someone's personal enemy. And people who went into the business were not doing it thinking about making a killing on Wall Street, and it was a highly fragmented industry, highly competitive, in many ways reminiscent in my mind of what we now see in the world of blogs, with all kinds of people cropping up out of nowhere, becoming experts on subjects and talking from their area of interest and expertise, trying to pull together audiences of like-minded people. It's worth remembering that at the turn of the 19th century, there were 28 newspapers in Chicago. And while the Chicago Tribune was the largest of them, it hardly had a unique position. The coming first of radio and then of television really did a lot to put the afternoon newspaper out of business. And then in the morning, a consolidation took place in most American cities, where we got to the point where we are now, where in many cities you really only have one predominant newspaper. Some cities will have two or a third. When John Carroll went to the Philadelphia Inquirer in 1972, for example, there was an afternoon paper called the Philadelphia Bulletin that had a bigger circulation. There was also a tabloid called the Philadelphia Daily News. The Bulletin had a slogan in Philadelphia: nearly everybody reads the Bulletin, and it indeed had a larger circulation. But over the next 18 years, when the legendary Gene Roberts was the editor of the Philadelphia Inquirer, it first overtook the Bulletin and then put it out of business. And one of the things that happened along with this was that the margins for newspapers began to grow rather quickly and rather substantially. And at the same time, a number of the families that ended up with the last paper standing, so to speak, started thinking about estate issues, started thinking about inheritance, and where there might have originally been an owning family who cared a lot, had a lot of complex reasons for owning a newspaper, being civic-minded, maybe wanting to control the mayor, maybe liking the profits, wanting to be a pillar of the community. That person was finding himself or herself willing to sell out to chains that really were looking at newspapers as tremendous sources of cash flow, and increasingly those chains then went to Wall Street to get the capital to expand even further. And so you began to see some very big newspaper chains develop. The Gannett Company, which now has about 100 newspapers across the country, started buying up very quickly. Two Canadian firms, the Thompson Company, which owned the Globe and Mail in Canada, but bought 130 small newspapers in the U.S. Hollinger bought another 100. You had the Knight family, you had the Ritter family, you had the McClatchy family, and then a number of these companies started merging with each other, and the margins started going first up into the 20s, and then with Thompson and Hollinger up into the 30s, where Thompson would sell any newspaper that could not deliver a 30% margin. With that, the quality of journalism fell off rather quickly in many of these communities where you had monopoly status, and with the disconnect between ownership and a local community, the emphasis on margins very much came at the expense of strong content geared toward a local community. And it became rather typical with many of these chains that both the editors and publishers would find that the route to promotion was to start out at a relatively small paper, spend a few years at it, get promoted to a somewhat bigger paper, and then move on from that to an even larger paper. And so the consequence of that was that instead of being locally owned by owners who cared a lot about the community and who were certainly in it to make money, but who really saw other reasons for ownership, you saw a disconnect between the two. And it's in that context that Tribune saw itself buying Times Mirror and able to put together a national organization that it thought could do things that went far beyond what either company could do in either of its two key cities. And so with that, I will turn this over to John to talk a bit about Times Mirror and Tribune and the specifics of the merger, and then we can come back to some specific subjects about the industry. So thanks very much.
I'd like to expand a little bit on some of the broad trends that Norm was talking about before I get into Tribune and Times Mirror. I think it may help you just to put this thing in a frame. In my professional lifetime, which has been 40 years or so, and even in my childhood, because my father was editor and publisher of the paper in Winston-Salem, there have been two very big trends in the newspaper business, two mega trends. One has been the transition from local family ownership to ownership by large corporations. And that's been a process that seems to me to have had a certain arc. It started out pretty well, and now it's a pretty unhappy relationship, the relationship between a local paper, particularly its journalists, and the corporate owners in a distant city. The purchase of newspapers locally by such companies as Gannett and Knight Ridder was the result of their seeing a wonderful opportunity. There had been many, many newspapers across the country, but in most towns it had settled down. There was one dominant newspaper company. And it took on the characteristics of a monopoly. They had pricing power with their advertisers. Advertisers really needed the paper to reach an audience of their customers, and there was no satisfactory other way to do it. So newspapers could pretty much raise their prices at will. This is a factor spotted by Warren Buffett, among others, and they made a lot of money off of that. There were also other reasons that made it a good business. Automation was coming in, so there would be cost savings and so on. And there were other reasons to believe that the business could be tightened up. I know that a lot of the papers across the South, including the Lexington Herald-Leader, where I was the editor for a while, when the corporate business people came in to look at them, some of them didn't even have a budget in writing. So they were very primitive from a business point of view. And they also, the new owners also figured they could save money by buying newsprint in bulk. In a newspaper, the second largest cost that you have, apart from your manpower costs, are newsprint costs. And you could save quite a bit by buying a lot of it. So you had this trend of large corporations buying up the papers. And then the second big trend, which is more current, is the devastation being wrought on newspapers by the web. And it is essentially a destruction of the monopoly business model. Anybody with a laptop now can sell ads in your town, and the web is attacking the newspaper business model from a number of angles. It's taking away readers. It's taking away advertisers. It is destroying the idea of paid content. You know, when you buy the print edition, you pay 50 cents or whatever for it, or you get a subscription. On the web, newspapers have pretty much accepted the idea that they're going to be free from now on. So they're down to one revenue stream, which is advertising. And the advertising business is viciously competitive. So newspapers can't price it the way they want to, and they also are unable to compete with all these other people who are selling ads but have a much, much lower cost base. New York Times is probably spending $300 million a year on journalism alone, much less its other costs, whereas other websites that I'm sure you all are familiar with can assemble gigantic audiences for advertisers by spending almost nothing. So the web has really put a hurt on newspapers. So those are your two trends. I would also like to raise the issue of culture. When the local papers were bought by the chains, many of the chains were run by people who had come up through the newspaper business and who didn't really think of the newspaper as purely a financial venture. They thought of it, as Norm mentioned, as having any number of purposes: journalistic purposes, social purposes, keeping the government honest, all those things. And they tended to support the culture of journalism as opposed to the culture of finance within their papers. People like John S. Knight, who was head of Knight Newspapers, had won a Pulitzer Prize as a columnist. I mean, he really breathed journalism, and protected those values within the newspapers that reported to him. Now he has gone on to his reward, and the next generation of people who came in running these corporations tended to be from financial backgrounds, from other businesses and so on, and they didn't regard the newspaper as something that had a special mission in society. They regarded it as just another asset. And that cultural difference was okay for a while, but now that the money has gotten tight and business has gotten hard because of the web primarily, the cultural differences have become accentuated, and there is a great deal of friction between the headquarters and the newsrooms. We have the spectacle of Sam Zell, who has acquired control of Tribune Company recently, and in doing so has put it under a debt burden of $12 to $13 billion, and he now comes into the newsrooms and literally curses the journalists because his business model isn't working. You know, he tells them, we're $13 billion in debt, we've got to make payments, what have you done about it? Well, journalists really don't know what to do about that. So you have a very stark collision here between the corporation and journalism. I know that you all are studying business here, but I approach this from a point of view of business, but also from a point of view of a journalist. And I think that there's something at great risk for society that's at stake here, and that is the public service mission of a newspaper. We journalists like to flatter ourselves and think that not only do we do this for a living because it's kind of fun, it's one of the more entertaining things to do. It's fun to hang around in the newsroom. There's a lot of jokes, and then you get to go out and see interesting things and so on. But we also like to have satisfactions at a variety of levels, and one of them is we like to be able to think at certain times in our life when we wonder why we did all this, we like to think that we did some good. Maybe we sent some people to jail who should have gone to jail, or maybe we kept politicians honest, or maybe we simply informed the public so that the public could vote intelligently and govern themselves. These are the higher end of the rewards one gets in this business. And that mission is not particularly valued by the financial owners. It's certainly not valued by Sam Zell. In fact, he's openly disdainful of it. So that's another one of the big issues I'd like to put out here. Now the case of Tribune acquiring the LA Times and the other Times Mirror papers will illustrate all of these points. And I assume that's one of the reasons that Professor Foerster wanted to do this session. And perhaps I've gone far enough in introducing this. Have I said what I should say now? Covered the points? And maybe we should go on to part two then. Thank you. Part one, excuse me. We're at the starting line.
Hopefully these guys have given you a pretty good background on some of the situations that they're facing. We hope that some of you have read through the case already. I know that everybody in the class should have. But we've introduced some questions here and some of the issues that were previously touched on. We hope to just kind of open it up to sort of a discussion. These guys have obviously a ton of experience. Just having breakfast with them was extremely interesting. So these are some of the questions, and hope to open it up. They can answer pretty much anything. and talk more about it.
Sure. You want me to start with?
Who wants to start?
Well, do you want to start with why Tribune bought Times Mirror?
Sure.
And I can talk a little bit about, you can talk about the life after the acquisition. I'm happy to talk about why they sold to Zell and why nobody else wanted it.
Well, I think one of the reasons that Tribune bought Times Mirror was that Tribune was at a particular point in its own development where it had a lot of self-confidence. It had been successful. It was running high margins, making lots of money. Their previous investments had been paying off. And I think that they started to read their own press. They started to believe their own press notices and thought they were pretty slick. And
it's interesting you say that. Having grown up in basically a 9-iron away from Chicago and Milwaukee, WGN radio was a 50,000 watt clear channel station, which probably means nothing to anyone in this room except Norm, John, me, and maybe Dave Brown, because it's really pre-TV, but you could hear WGN in a lot of places, particularly in Milwaukee. And WGN stood for World's Greatest Newspaper. And interesting you say about how good they were feeling about themselves. That was their original stock trading symbol on the New York Stock Exchange. Should have been WGN, World's Greatest Newspaper.
They were riding high.
Because I think you brought up an interesting point. So you provided in your earlier conversation about acquiring small town newspapers some pretty compelling real synergies in terms of newsprint purchasing and bringing professional business practices. But I think what you're saying is the acquisition of LA Times doesn't fit necessarily that model. This might have been what people in business have required, a little hubris, a little feeling good about ourselves.
Well, they had some other rationale that certainly Wall Street bought.
Yeah.
Which I mean, you can get into or I can, but I mean it was very much the idea that if you put these two papers, it was very much kind of a Madison Avenue notion that if you are powerful in New York, Chicago, and Los Angeles, you can put together, with those three franchises, you can put together sort of national selling plans. And they would have had, with Newsday in New York, the LA Times and Tribune, it looked like they had newspapers in the three big markets and they had TV stations in the three big markets.
So then I get it right. So somebody who wanted to advertise nationally would now be compelled to come to the Tribune Company because they would cover those.
Well, that was the way they pitched it. I think John can explain that compelled hardly works when you actually looked at what those assets actually delivered in terms of audience.
So anyway, they came into this with a lot of self-confidence, and you know how it is in your own life. Sometimes you really think you can conquer the world, and then sometimes you think you can't. And they were at a sort of a high point in their self-esteem. They also had an inside track. It was believed throughout the newspaper business that the Times Mirror could not be sold because of legal restrictions having to do with the Chandlers Trust. The Chandlers were the family who controlled the voting stock of the LA Times. And I should give you one little bit of background here. We in journalism would often refer to the good Chandlers and the bad Chandlers. And the paper had been run historically by bad Chandlers, people who used the paper to promote their real estate interests. And if you've seen the movie Chinatown, that whole business about stealing the water from the Owens Valley and irrigating L.A. and opening up for development, the L.A. Times people were key players in that. And the paper was largely a promotional instrument for their land speculation. So it wasn't a very respected paper. Then around 1960 or so, along comes Otis Chandler, who is quite a golden boy of Southern California. He was an Olympic caliber shot putter at Stanford, and a surfer, and a big guy with a great physical presence. I'll tell you a little story about him. When he was head of the whole empire, he was on the elevator with a bunch of people at the building, and he was taller than everybody, big-chested, just a wonderful-looking specimen. And this humble woman, whose job it was to deliver the mail from one department to another, pushes her little cart onto the elevator, and she looks up, and she's looking at Otis Chandler, and she says to him, "What is it like to be rich?" And he says to her, "I don't know. I have not ever not been rich." Anyway, that's Otis Chandler. But Otis Chandler was tired of being disrespected among his fellow publishers, and he built the newspaper into something exceptional. He invested in it, he insisted on hiring the best journalists, and so on. And the paper was transformed dramatically under Otis. Meanwhile, the bad Chandler side of the family was very resentful, partly because Otis had aced out Uncle Philip, who they thought should have had that job. And then the family split there was aggravated by the fact that Otis had made the paper liberal, and they were very conservative, extremely so. Some of them were involved in the John Birch Society, which some of you may know about. They thought President Eisenhower was a communist, basically. It was that far to the right. And so the good Chandlers and the bad Chandlers are actors who will play out throughout this history. It was discovered by a young lawyer, I think, rooting through papers in Delaware, that actually the papers could be sold. They could be acquired by Tribune Company if they had unanimous or near unanimous approval from the Chandlers. Is that right, Norm?
Yes.
They needed, it could be sold, and nobody else believed that, so nobody was looking at it. But Tribune figured that out, that it could be acquired if they had a certain level of cooperation from the Chandlers. Well, Otis had kind of gone on. He'd left the papers by then, which left nothing but bad Chandlers. And the bad Chandlers were disillusioned with the slowing of growth of the papers and wanting to get their money out of it. And so hence a deal was possible. Another factor was the poor management at the Tribune Company, the Times Mirror Company. They'd gone through a number of regimes, and they'd finally, in desperation, gone outside the newspaper business, brought in Mark Willis from General Mills, who was by the newsroom, newsrooms which tend to be disrespectful. He was known as a serial killer, C-E-R-E-A-L, killer. And he did a number of kind of ill-advised initiatives that made it pretty clear that the papers weren't going anywhere. So the Chandlers didn't know what to do but sell. So they were ready to sell. And another reason why the Tribune would want to do this deal is that they were acquiring a much more prestigious and better level of papers than they had had before. So just to finish up with their rationale that they came up with for wanting to do this deal, and Norm has touched on this. They had several reasons why they thought it might be a good business move. One of them was the market for national advertising, print national advertising, which was big, it was billions of dollars. A lot of magazines were getting those ads. The New York Times was getting them. Newspapers, incidentally, charged more for national advertising than they do for local advertising. And one of the big moves that the New York Times had made was to convert the majority of its advertising into national advertising by circulating nationally. And that was a very lucrative move. You had USA Today created, it was getting national ads. The Wall Street Journal was getting national ads. So Tribune looked at this as a big boon, and they had, as Norm said, newspapers and TV stations in New York, LA, and Chicago, and they thought we can get a piece of that. They also had two other, yes?
With respect to the fact that they had the newspaper and the TV station in each of those three markets, how much weight was placed on the FCC cross-ownership regulation, which said they did not do that?
A lot. You know, traditionally there have been, in modern times, a concern on the part of government that no one operator be able to dominate the media in one community. And they had rules that you couldn't own a TV station if you owned the newspaper and so on. But with the trend toward deregulation, that was getting loosened up, and Tribune was counting on that. And with the acquisition, they end up with newspapers and TV sets in the same markets, and they still have them. But the legal status of that is not yet resolved. But you can tell that the FCC is in no hurry to break that up.
Well, the FCC approved them for Sam Zell in December, but prior to that, when Tribune came in, they had a long-term carve-out exception for Chicago for their radio station, and in New York they had WPIX, which was Channel 9, and Newsday was actually a Long Island paper, so they got an exception there. And in L.A. there was it was subject to rather periodic review, but nobody really saw KTLA as being that. It's a pretty big market and pretty fragmented, so they had a kind of grandfather clause for the three. At the time of the merger of Tribune and Times-Mirror, they got those three approved.
So that was a factor.
But it was an issue. It was a factor. The merger was contingent on getting at least those three approved.
Yeah, and if the national advertising was a big part of their justification of the purchase or of the merger, also synergy. Having this TV stations and newspapers in the same market, they refer to that as synergy. They thought that the two could work together to sell ads, to share content, to do things that they could do better. You know, they could increase their advertising and their efficiency by doing that. And that was sort of the second leg of the rationale. And another piece of it was cost cutting. Tribune is a very good cost cutter, and they thought that Times-Mirror was fat, and they thought they could get a lot of costs out of it. So those are the three things, and I won't tell you how that worked out. We'll save that for a little later.
Could you guys talk for a second? You mentioned the two classes of stock at Times-Mirror. Talk about dual class ownership at a number of major newspapers versus most other companies today in America.
Well, I don't remember Times-Mirror having two classes, did it?
I think they did.
They did have two classes. A number of news organizations set up two classes of stock by which they were able to separate the economic control from the voting control. And this is legal under stock exchange rules. The rationale behind it, but only refused to do it. And there aren't many companies outside of newspapers that have done it. Comcast has in the cable industry, and the rationale behind it is that a shareholder knows what he or she is buying, and if you don't like it, you don't have to buy the stock. But from what it did for the families was it allowed them to maintain voting control over a company even if they didn't have economic control. And in the case of Washington Post Company, New York Times Company, Dow Jones and Company, Times-Mirror, the argument that would be made to shareholders is that we are not just a business, we are a quasi-public trust, and we need this second class of stock to protect our journalism. And this has come under attack in different ways. Rupert Murdoch attacked it at Dow Jones last year by offering a premium of 60% over the price that the stock was trading at, and the Bancroft family decided to screw the public trust and take the money, and that was a pretty easy call because the family had had nothing to do with management for 50 years, and the money was really far above anything they could have ever imagined seeing for that paper. Again, Morgan Stanley tried to buy into enough Class A stock to get board seats at the New York Times, was discouraged from ever doing so and went away. 2 hedge funds recently did buy in pretty heavily and got 2 board seats at New York Times Company, but the feeling is at least the current generation of management is likely to be able to hold on there. At the Washington Post Company, the Washington Post Company has tended to have a higher level of independent directors than most newspaper companies have. Warren Buffett has been on their board for many years, Barry Diller from the IAC Group, and one of the things that Washington Post Company did, actually over the objections of the Grand family, was rather than expand into newspapers at the time that that Tribune and when the New York Times was buying the Boston Globe and Tribune was buying Times Mirror, the Washington Post Company was buying Kaplan Educational Services, which now contributes about 70% of the net income to that company, and that's one of the reasons Washington Post Company is doing as well as it is. One thing that is worth mentioning in terms of the acquisition itself, and should not be overlooked, is that in addition to the newspapers, and the Tribune Group ended up with 11 newspapers, it ended up with 21 television stations, and 15 of them, it gave them a lot of clout, particularly with Warner Brothers, because Warner Brothers was starting a network called the WB, and Tribune was able to get very good terms from them in terms of carriage of the WB stations, and when the WB merged with Viacom's, what was it called, UPS, to create the CW, 15 of the 21 Tribune stations are now part of the CW and are a very important part of it. And when they did the merger, they actually thought they might start doing television production in Hollywood as well and start creating their own TV, and thought that there was at least the potential that not unlike the way Fox had become a fourth network under News Corp and Rupert Murdoch, that Tribune could start its own TV network. And while we all tend to focus on the power of the newspapers, the merger of those TV stations, giving them 21 stations across the country, was also something that they thought was a tremendous asset for them. I think it's also worth remembering at the time of the merger, if you will, the first internet boom had come and crashed, and so there was a lot of fear about newspapers in the late 90s, but some of that was sort of put to rest as so many of the internet firms really crashed. But as the merger was coming together, the power of the internet really came back, and in ways that really began to hurt the business models of these newspapers. If you think about what a newspaper traditionally does, it's a publication of record, it's timely, and through its classified ads, it creates a transaction that can take place. And if you think about the internet, it's far more timely, it has no capacity constraints, there's no press limitation, and it's made for classified ads. If you just compare a Craigslist with the classified section of any newspaper, it's a whole lot easier to find what you're looking for on Craigslist, and so a number of newspapers really have seen tremendous fall off in their advertising. The second thing that has happened that is really not the fault of Tribune Company is that a lot of traditional newspaper advertising has really undergone fundamental change in the last few years. We've seen a national consolidation of department stores into Federated and Macy's and so forth, and this has led to different kind of advertising. Detroit has cut back on its subsidies to dealers for automotive ads, and so local automotive advertising in newspapers has fallen off pretty sharply. There was 1 year, movie advertising has migrated very much to that. I know there was 1 year, John, I don't know if you were still there, when Lord of the Rings, I think, won 11 of the 12 Oscars for movies, which meant that the second quarter LA Times earnings were down rather sharply because traditionally the week after the Oscars, all the movies that win Oscars just flood the LA Times with full-page ads for the movies, but only Lord of the Rings was doing it that year. And so you had some aberrational things just in the way advertising was changing that were also affecting the newspaper business. And in the last couple of years, Tribune has been hurt in some of its key markets by the real fall-off in the housing market. Housing advertising has been particularly important in Orlando, in Fort Lauderdale with the Sun Sentinel, and in Los Angeles. And so when you put all of that together, that has hurt the economics of all those publications. I would say, however, that the main thing is that, as John suggested, post-acquisition, editorially, they never really got the synergies that they expected. There was, John can talk about the LA Times newsroom and how it felt about Chicago. I know he had a columnist who is still at the LA Times, Steve Lopez, who regularly, I don't know, some weeks it was the hog butchers from Chicago, some weeks it was the hod carriers from Chicago. I wasn't quite sure which was the more derogatory description, but you know, John had a newsroom with more than 1,000 journalists in it. There were about 600 at the Chicago Tribune, and I remember the editor of the editorial page at the Chicago Tribune, what was his name, Warren, I think? I'm trying to remember. Jim Warren. Saying to me, now, you know, we're just as good at a newspaper. It was the week you won 5 Pulitzers at the LA Times. He was explaining that he didn't understand why LA needed one more reporter than Chicago had because it wasn't any better newspaper. And so that kind of rivalry and that kind of tension was sort of permeating throughout the organization. And similarly, you could imagine that the cost cutters would take a look at it and say, well, why do we need 11 movie reviewers for 11 newspapers? Why can't one reviewer write the same review for each newspaper? What difference does it really make? And you would be seeing those kinds of battles going on across the place. So you had, I think, a number of things happening with regard to Tribune between the time of the acquisition and the time it got put up for sale. But part of it was that the synergies weren't really working. The earnings were not increasing at the rates that people were hoping for, and some of that was for conditions beyond their control or because they had false expectations to begin with. They sold off the magazine group rather quickly. The Times Mirror magazines were sold to Time Inc. But you also had some cultural differences that were real. And meantime, Wall Street began to sour on newspapers generally. In the fall of 2005, a hedge fund owned by a guy named Bruce Sherman, who only owned 3% of Knight Ridder, started complaining about its Knight Ridder started complaining about its performance, and he managed to get that board to have an auction of a newspaper chain that included a number of very important, very big papers, the Miami Herald, the Philadelphia Inquirer, probably 30 newspapers across the country. And I know that they assumed that this was going to be a huge auction. Every major private equity firm in the country was contacted, took a look at it. The stock was trading in the mid-60s at the time that the auction began, there was only one private equity bid that came in, and it was very squishy at 57. And in the end, McClatchy came in with an initial bid of 63. Goldman Sachs, who was managing the auction, got them to lift the bid to 66, but they only did that because they had a deal where they immediately turned around and sold 8 of the newspapers to Dean Singleton at Media General the day they closed on the deal, because the people who were looking at the Knight Ridder papers just going forward could not see those trends turning around, couldn't see classified advertising coming back, couldn't see a return of big national advertising, couldn't see any of the rationale for that chain, couldn't see further efficiencies. Every newspaper chain in America was trotting out business models that showed 2% growth in revenues, and every private equity firm that was doing its own modeling was showing 2% declines in revenues over the same period. And so I think the fact that Knight Ridder was put in play put tremendous pressure on Tribune Company to sell when the Chandler family started complaining about the fall in the stock. And you would remember these prices because you had stock options in Tribune. But my recollection was that it was in the high 50s in early 2006 and was in the high 30s at the end of 2006.
I just remember the long decline and how I didn't sell.
Do either of you know whether the purchase of Times Mirror was Tribune driven or investment banker originated and driven?
I think it was Tribune driven.
You do?
I do.
So the idea germinated in Tribune management or inside the Tribune board?
Yeah, the original idea came from a conversation between Jack Fuller of Tribune Company and I think David Laventhal. I think that Fuller picked up the idea at that point.
I think it's...
Did you take that one step further? I mean, in my own business, investment banking, we had a Wall Street Trade Group, which we've covered in our Capitalism class. And you go to a convention every year, and you meet your competitors and have meals and drink with your competitors and share stories. And the newspaper industry had the same, correct?
Sure.
And so everyone in management at these big shops knew everyone else, correct?
Yes.
Yeah. It is worth noting, though, in the investment banking business that there are investment bankers who cover specific industries who regularly call on potential buyers, be they financial or strategic, on a regular basis, whether a company is in play or not. And they get huge fees. Carlyle alone pays several $100 million a year to investment bankers. And these guys walk in with these books and tell you that, they had a conversation with somebody in the company that leads them to believe there could be a transaction. And that usually means that there was a 2-paragraph article in the Wall Street Journal that there's a new CFO who somebody once played golf with. I mean, it's complete BS. But in any case, these guys come in with their books and their Excel spreadsheets, and they lay out to you how, I've sat through these things, and these are people who have never actually worked in a company. And, I had one guy come in, I remember it was for Gannett, and it was about a year ago, and he showed how the stock was trading at, mid-30s, and they had a scenario to take the stock to 60. And how this is, the credit markets are frozen up and private equity at this point isn't buying anything. But in the early part of 2007, I could look outside my window in New York and think about buying Canada. I mean, it was just, what banks were willing to lend money for anything. And, this guy was saying, well, here's Gannett. They've got 100 newspapers and, they've got 43,000 employees, and if we could cut that to 33,000 employees, this is what it does for your IRR. And I sort of said, well, how did you come to the number 33,000? Why not 30,000? Why not 35,000? He said, well, 33,000 gets your IRR up to 35%. So that was how he got to that number. There is a lot of that stuff going on. When Tribune first announced, and what they usually announce is they've retained investment bankers to pursue strategic options.
I tell the class what that's code for.
That means we're for sale. And then other investment bankers come in, and I mean, we had, at that point, Tribune was trading at about 36, and you had some shareholders with fairly high blocks of stock who were really trying to push a deal. There's a company called Ariel Capital in Chicago that owned about 6-7% of the company. They were saying they wanted to see a number with a 4, and they'd be voting and so forth. And I know one investment bank came in with this scenario that said just grow revenues 2% a year, cut expenses 2% a year, and you have a $70 stock at Tribune. And I, having known this guy, said, well, show me how you're going to grow revenues 2% a year. I was looking at what was happening at the LA Times, where revenues had declined quite sharply, and they had no real answers to these things at all. This was pure spreadsheet, Wall Street, sort of playing around with stuff. Well, you could sell the Cubs and get $1 billion. That was one idea, and maybe somebody will sell the Cubs and get $1 billion. But
a sparkling white building on Michigan Avenue, right?
You could sell the building. You could sell the interest in the Food Channel. Of course, the trouble is, for instance, you're not allowed to sell the baseball team during the baseball season. So that's half the year that you're not allowed to sell. And then there's the issue of whether you sell the team or you also sell the cable rights to the team. And if you sell them together or separately, those issues get a little complicated. The Food Channel is 2/3 owned by Scripps, who has a right of first refusal, and can block anybody else from buying it whom they're not comfortable with. So that might have a downward pressure on the price. So all these things have problems. But in any case, I don't know. Maybe it is worth getting into the question of why Tribune sold its assets to Sam Zell. If you're comfortable, I'm happy to talk a little bit about that, unless you want to focus on some other stuff first.
I wanted to make one other point. Norm mentioned Ariel Capital owning some 6-7% of Tribune. Increasingly today, because of CNBC, because of increasingly Bloomberg, Fox Business, various other outlets, hedge funds can be very aggressive players and talk their book. Can you just speak to that for a minute? And that sometimes has an impact.
Well, sure. If you're a 3 to 6% owner, first of all, the proliferation of business news is really quite extraordinary, and the rules about what you can say are quite extraordinary. I mean, usually companies are constrained from saying anything unless the information is broadly disseminated so that all shareholders have access to the information at the same time. So that's why there's a PR news wire, or you give it to a Dow Jones news service, or a PR or a Bloomberg or something. But with 3 24-hour business news channels, Bloomberg, CNBC, and Fox Business News, with a lot of business news on the 24-hour business channels, with a lot of business magazines, and with now more mutual funds than there are listed companies on the New York Stock Exchange, the desperation for publicity is really quite extraordinary. So, for instance, a guy like John Rogers, who's a really smart guy who runs Ariel Capital, has a column in Forbes that runs every other issue where he picks the 10 stocks he likes. You could actually have a very interesting column that just goes around writing the track record of all the other columnists. But, you know, a guy you know, these outlets are constantly looking for people to quote, to tell a story, and people are always trying to pitch the angle, usually based on what they just bought. You know, trying to goose that stock and so forth. So we live in that environment, you know, where management would, in the past, typically have had shareholders who were patient, long-term investors. Increasingly, the control of publicly held companies in America today is institutions that have no particular loyalty to the stock, but only to the price of the stock. And it's not just hedge funds, it's pension funds. It is insurance companies. It can be private equity, although private equity usually prefers to buy control of a company. And as a consequence, you know, you wake up one morning and you, as Time Warner did last year, and Carl Icahn owned, you know, not all that much stock, but enough to make a fair amount of noise and actually change the behavior of the company. So you do live in that environment, and that's why I think when Tribune saw how easily Knight Ridder had been in play and the Chandler family was complaining about how its stock had fallen by 40% and what was Tribune going to do about it, it was very tempting to retain an investment banker and say, we're going to consider all strategic options.
Suppose they hadn't sold to Samsel, what do you think would be happening today? Anything different?
If they just decided to, they just say no defense and they were just running it as is?
Just keep running Tribune Company.
I don't know. I mean, I think it would continue to be in decline and an untenable position for, you know, for the management. I was amazed, really, that the board didn't act a long time earlier to change the management. The management, I thought, was failing. But it's a kind of a club up there in Chicago, from what I could tell. They'd all go, you know, they owned the Cubs. They'd all go and sit in the box, and there were a lot of overlapping boards. They didn't have. It was a pretty monolithic board of people who were kind of cronies in Chicago, with the exception of the four seats the Chandlers? No, they had 3 seats in the end, with another guaranteed to be from California. So they had 4 Californians. And the 3 Chandler people were at war with the rest of the board.
And there were these trusts. The MacArthur Trust
Mm-hmm.
had a seat, a board seat, but that was reserved for Chicago, for a former CEO of Tribune.
But it didn't seem to me that the board was very much invested in stewardship of the company.
That doesn't make it that unusual of a company, in my opinion.
Yeah.
I mean, Norm is spending a lot of time now teaching and talking and studying corporate governance. I'm certainly a student of corporate governance. I'm unimpressed with what's going on inside a lot of boardrooms. I'm glad we brought this topic up. And you have to wonder how much time can an outside independent director, if there were any on the Tribune board, spend doing that? And was the lack of time invested by those people part of the reason the company got into its problems? Because management could just do what the hell they wanted.
Well, look, with the benefit, you can second guess a lot of this stuff, and with the benefit of hindsight, there's certainly a lot of things management might have done differently, including not buy Times Mirror. I think a lot of the criticism of management, and John was living it, was most of us as managers, you know, will, I mean, as ugly as it may sound, would far prefer to have a CEO who at the beginning of the year says, here's your number, I don't care how you hit it, but just do it, and then essentially leaves you alone. And what I saw at Tribune was not only management by meat axe, but it was then sort of followed by, you know, sort of the invasion of mayflies. I mean, it was this, you'd have these people who would come in and sort of with this draconian cut that you swallow hard and say you take, and then a whole second group would come in and say, well, we're from the newsprint people and we think the paper stock is too heavy. And then you've got people who are saying, well, why are you using so much ink? And then, and so it was, sort of everyday cost cutting, and it just makes it very hard to run a publication in that environment. And frankly, not a lot of serious thought to how you could grow revenues. So it may very well be that, like it or not, the newspaper business is in a period of true secular change where technology is resulting in declines that cannot be reversed, and that local television's business model is not a whole lot better. That said, I think the way the place was managed over the last 2 years exacerbated all of those problems.
Mark?
I was just going to say, with all the cost cutting and the issues between Chicago and LA, when they were cutting jobs, were there significantly more cut in LA versus Chicago?
I think so. I didn't pay. I was such a war. I wasn't paying a lot of attention to Chicago, but I'm certain that that's true. I thought that I might add a few things that fill in some of the detail on what Norm was saying. Norm said much earlier, and we discussed that the strategy that Tribune had in acquiring Times Mirror and the national advertising never worked for a variety of reasons. The synergy never brought in much, and I'd like to give you just a glimpse of how that played out in L.A. In L.A., we had the L.A. Times, which was quite a serious newspaper, kind of a New York Times-like paper. And then we had KTLA, which was Channel 5. It was not a particularly respected source of news, and it didn't have very high-grade programming. And, the main thing that you would watch the news for was car chases and really, really good-looking journalists. Lots of low-cut outfits and so on. And, they would exhort us from Chicago, work together. And we're trying to think, what can we possibly do? And there were some ad sales teams and things like that, but it didn't add up to much. And the day that it crystallized in my mind that there's really not a lot in common journalistically was when I was at home and I got my Sunday paper. And KTLA had in it one of those inserted ads. It was a very slick brochure for KTLA News. And it had, each page was devoted to a KTLA journalist, and they were all like that, and quite good looking. And it would have
men and women, I might add.
Men and women, and they would have a little standard box, a little chart of information on each journalist on the page with the good-looking journalist. And if it had been print journalists, LA Times journalists, you would have said, well, he covered Russia in a certain period of time, and he was editor of something and did these things like that, kind of dry credentials. But in the box that gave the credentials for these journalists, it would have birth date, and it would say January 23rd, but it wouldn't say what year. And then the next category was sign of the zodiac.
Right.
And how does that blend with LA Times journalism? I'd never got that, but I thought that it didn't add up to much, I'll tell you. Synergy. When these strategies failed, they fell back on cost cutting. And the first heavy cost cutting, it was about I think by the end of 2004, they bragged that they cut $130 million out of our costs at the LA Times, annual spending. And most of that had come out of the business side. And when you read coverage of what's happened in the newspaper business, you always read about journalists being laid off and journalists being a loss. But the business side gets whacked and nobody ever writes about it. And the business side is absolutely crucial to the business success of the paper. I'll give you one example of why the LA Times ended up losing more circulation than other papers. All papers are going down almost, but the LA Times went down at a faster rate than most. And there were a lot of reasons, and nearly all of it had to do with cost cutting on the business side. A newspaper, even in the best of times, is like a sinking ship. You're always losing readers. You're always losing subscribers. They die. They move. They don't have time to read anymore. They get more interested in something else. And just in order to stay even and not be losing readers, you have to do a lot of sales. You've got to really push it. You've got to promote it, and just to get to the even point. And the apparatus for doing that was pretty much obliterated at the LA Times. I'll give you one example for that: promotion. When I arrived at the LA Times, we had a promotion budget of $12.4 million annually to spend promoting the paper, which in a market the size of LA is not all that big, but it's okay. By 2005, it was $300,000. It was more than decimated. It was reduced to a tiny fraction, from $12.4 million to $300,000. If you've got $300,000 for promotion in LA, you might as well not spend it, because you're not going to reach anybody with that amount of money. And I said to the publisher, I said, we might as well just put a gun to the paper's head if we're going to do this. So that was part of the cost cutting that it troubled me a lot, because I thought that we were not being good stewards of the paper for the next generation. And one other example, which has even more directly to do with the stewardship for the paper, of the paper, and keeping it alive for the future. The website. I don't think it was an accident that the family-controlled papers like the New York Times, Washington Post, and Wall Street Journal end up with very good websites. They really, really invested in them. Whereas the LA Times, we were sending so much to the bottom line that our website was lousy for a paper of its size. We were one of the last papers, I think, even to get hyperlinks in our stories. I mean, we've just fairly recently got hyperlinks, which, as you know, if you're serious about being a web publication, that's pretty much a key. And the website was starved, but it also reflected the cultural division between Times Mirror people and Tribune people. There never was a happy marriage between the two companies for a variety of reasons. Not a single Times Mirror executive ended up in the inner circle in Chicago. It was like a little club, and nobody could crack it. And in the websites, the Tribune Company insisted on controlling the websites. They thought that they could put it together into something that would add up to more than a bunch of local websites. But what it ended up doing was just paralyzing the local people who are trying to do good websites. There were so many rules and so many controls on them that after a while, if you're managed that way, I hope you all never have this experience, but you probably will. If you're managed by somebody who's really heavy-handed and second-guessing your every move, you'll pretty soon give up on being creative. You'll just come to work and get your paycheck and probably leave the company after a while. And that's the way it was in the website. And I think everybody agrees that the future of the business is digital, it's online, and we should have been investing more heavily in that, and we should have created a management structure that worked for that and allowed people to be creative and didn't just put them in little narrow channels. So those were a few of the things that, as the failure of the merger played out, caused the company to go in the wrong direction.
John, how many off-site meetings did you go to with maybe the top 10 or 15 people in Chicago and the top 10 or 15 people at the LA Times to try and sort the cultural...
We never did that.
What?
We never did that.
Never.
No. There was something that, I mean, we had some contact. I didn't have much contact with Chicago. And they didn't have much, they would send in lower level people. You know, Norm, I didn't realize you knew how this worked, but you're exactly right that there was a person who would come in and second guess you on newsprint, a person come in. They were looking at every single category in which we spend money, and they had somebody who was finding the paper that was doing it the cheapest, even if it was a really lousy paper, and it would get everybody down to that low level. I mean, they call it
best practices.
Benchmarking.
Yes.
And
best practices.
Yes, best practice, but it never worked up. I mean,
Yeah.
if somebody was spending more money and doing a fabulous job, the other papers would not spend more money. It was a one-way street.
Same with the content of the articles that you published. Like, was there one voice disseminating from the top, or were the individual subsidiaries just governing their own content on their newspaper?
No, we didn't get, well, we didn't, they didn't successfully impose content on the LA Times. But toward the end, there were efforts to do that. There was a plan, for example, to put out one business product, business section. And it was run out of Chicago, and the prototypes were awful. And here's an example how the Tribune Company was kind of managed and it kind of wasn't managed. They asked our business editor, do you want to be part of this? And he came to see me, and I said, no, we're the LA Times. You know, when you get a paper like that, think what you'd get if you got the New York Times one day and the Orlando Sentinel had, not the Orlando Sentinel, the Gainesville paper or whatever, one of their subsidiaries, was doing their business section. It's no longer the New York Times. And so the business editor came to me and said, do you want to do this? I said, no. And so he told them no. Later, nobody ever came to me directly and said, do you want to do this, or tried to talk me into it. I mean, it was kind of unmanaged in that way. But later I learned that that was considered a really bad thing that I had done, and that it widened again, that I had done. That we weren't good citizens of the company. You know, I might have said no if they'd asked me, but nobody even asked. So there was this distance between them and us. And
let me take a little contrary view on that, just to shake things up a little bit. I spent 4 months looking at Tribune Company from a Carlyle perspective as a private equity firm, and although I came out of an editorial background, you have to understand that private equity gets its money from investors who have only one interest, which is a return on their investment. And Carlyle has about $80 billion under management, and 5% of it is owned by CalPERS, the California Pension Retirement Fund. It's got pension funds, it's got sovereign wealth. Abu Dhabi owns 7.5%, and they don't really care whether you're in coal mines or blood banks or alternative energy or real estate or newspapers. So there's no, I mean, if you think that there's a problem of shareholders who don't care about public interest in journalism, private equity clearly has no such interest at all. And I think a reasonable debate should be had about whether the public interest function of newspapers is something that is compatible with either public ownership or a private equity kind of ownership, or whether we need to have foundations that own newspapers, or whether that public interest kind of journalism has to be done someplace completely differently. But when I looked at Tribune Company, the kinds of questions that I asked I mean, there are a couple of reasons. We bid on Carlyle bid on the TV stations, but in the end we did not bid on the newspapers. And part of it was just these macro trends that made me very nervous that I couldn't see how you could grow revenues no matter what you did. but I also did see some cost issues. And the general rule, which John is suggesting and that I would agree with, is that the more decentralization, the better. I mean, the worst sentence in the English language is, "I'm from headquarters, how can I help you?" But because if you're local and you know your markets, you know the idiosyncrasies, you know that the people of Gainesville may have interests in subjects that are very different from the people of Knoxville, even though both are, or Chattanooga, which are both owned by the New York Times Company. On the other hand, when I pick up this morning's paper here in Gainesville, and it's a New York Times-owned paper, and I see that 90% of the copy in the first section is Associated Press, it's not particularly clear to me that there's anything local about that paper either. But that aside, when I was looking at these Tribune papers, I was asking here are the kinds of questions I was asking myself, and not necessarily coming to answers with them. But Super Bowl. Chicago Bears are in the Super Bowl. It's in Chicago. Tribune is covering this thing like it is World War III. I mean, they have got reporters, photographers all over this story. The other 10 newspapers of the Tribune group together probably had between 60 and 70 people at the Super Bowl. Now, this is not going to change. It's a rounding error in terms of the earnings of Tribune Company, but you would ask yourself, from a management point of view, whether the Chicago Tribune Sports Department couldn't have done a good enough job covering the Super Bowl. And part of the answer is, well, they'd give us the Chicago perspective, and it would be too one-sided and so forth. But maybe you could have cut a deal to get one reporter covering, something other than the Chicago Bears. But you were looking at it and asking yourself why these 10 newspapers had to be at that event. The one thing is a national story is entertainment, and the one thing that the Los Angeles Times covers as well as anybody in the country is entertainment. That it has a daily section called Calendar that, in terms of movies, music, television, popular culture, is second to none. That had movie reviewers that were the best of any in the country. I mean, I guess Ebert was at the Sun-Times, but certainly there was nobody at Tribune who came close in terms of covering entertainment. And so you did wonder where business might be local. The opening of Shrek 3 in each of the 11 cities of Tribune was, to me, pretty much a common event. Why the LA Times coverage of the making of Shrek 3 wouldn't be good enough for those 11 papers, and whether you couldn't have been a whole lot more rigid in saying that that's the editorial that's going to be used for it. The Washington Bureau had a bit of duplication in terms of, there's a lot of prestige in terms of having a reporter at a White House press conference. How many people really need to be there to cover these mindless events, is another subject completely. But those were the kinds of things that, as a private equity person looking at the cost structure of these newspapers, I was looking at. You would look at how staff was used, and I was asking myself with the LA Times, saying, gee, in many ways this paper reminds me a lot of the New York Times in terms of size of staff, in terms of where reporters are based, in terms of stories that are covered, although obviously with a West Coast bias to it. But if I look at the makeup of the LA Times, it covers a 5-county area, but it's the number 2 paper in 4 of the 5 counties. The numbers may have been wrong on this, but I remember the statistic that got put out suggested the number of college graduates reading the LA Times was significantly lower than the New York Times or the Journal. And I don't know if that was a right number, but it was like 42% against 72% at the New York Times?
You know, I think, I can't remember the particulars, but I think that was a very misleading statistic.
Well, it was the statistic that was in the book that was floating around, if you will, for that Tribune put out for the investment banks. 50% of the audience for the LA Times was Hispanic, not Spanish-speaking, but Hispanic. And so when you start thinking about if you were going to design a newspaper from scratch for the Los Angeles area, you had to, if you were doing it from scratch and you were not imbued with all of the desires to do great journalism, but were trying to figure out what is the most profitable newspaper I could produce for Los Angeles, which was, if you will, the private equity approach, that paper might have looked a whole lot more like USA Today than the New York Times, with a very heavy emphasis on real estate, a very heavy emphasis on sports, very heavy emphasis on Mexico and on the Pacific Rim. Certainly bureaus in Tijuana, in Guadalajara, in Seoul, in Manila, almost certainly not a bureau in London and Paris, in maybe Moscow, much more emphasis on China. So those were sort of things you'd look at. You'd wonder whether one Washington bureau couldn't serve all 11 Tribune papers. And I think they ended up all in the same floor, but it was a separate entrance for the LA Times, as I recall.
All the bureaus are separate.
They were all separate.
But they're on the same floor, and there's sort of a common meeting space where they talk every day. A common meeting space
and a common receptionist, but I think that was the only economy that came from it. And so I don't know. In the end, we didn't bid on the newspapers because, frankly, I didn't think the problem was a cost problem. I thought it was a revenue problem. And even if you got some one-time savings, I mean, who knew what the right number was for the LA Times staff? There were all these debates, should it be 860 or 910 and so forth. And I just thought the real issue was, is there anybody in America who sees a way to grow revenues for newspapers? And the websites you can see growing, but you can't monetize them as well as you can to cover the losses with the print product. And that, in the end, to me, was a sort of a bigger problem than that was exacerbated by bad management. But that, in the end, was what I think was the biggest problem for us. Yeah.
Maybe this is out of sequence a little bit, but when you talk about capturing a lot of the synergies and the economics of combining several newspapers together, and the flaws of the decentralized model, or excuse me, the centralized model, and they're very obvious. I live in Gainesville, and I've never in 15 years read the first 7 pages of the, because I can get the world news from other sources or electronically, but I'm incredibly interested in local businesses and the local angle, and the coverage of the University of Florida sports is generally quite good as well. And so why can't we have, and that's a New York Times paper, as you know, why can't we have, what stands in the way of somebody that would take best practices and enjoy the synergies from global buying power, et cetera, and having news staff that's really world-class in the areas that we want, and then tailoring a paper. The Gainesville Sun, I've just described what it looks like. You've described what the LA Times would look like if it was meant to be sold to the LA audience. What stands in the way of that kind of a ultimate product? The newspaper family could have a very distinct footprint in every market.
Well, John, you would probably know this better, but my guess is that there's a fair percentage of people living in Gainesville who don't look at other sources for news, and for whom those first 7 pages are probably the only source. I mean, it's the thing that I always found with urban newspapers is a surprising number of people actually did read those international wire service stories that I never thought were all that good.
Well,
but
Norm, if you went Professor Brown's way, and I asked Norm and John at breakfast, why doesn't a group in Gainesville get some private equity money and buy it and do what you're saying? If you run the first section all AP or Reuters or Bloomberg News Service or whatever, you have no staff for that. How expensive is it to put that on paper?
Yeah.
Can that be done cheaply?
Yeah, more cheaply than staff-written stories, but you still have to spend. Every page in the paper costs money. I mean, the newsprint and so on. And you have to edit, and you have to write the headlines, and so on and so forth. So it's not free, but the cost of the material is minimal, the cost of the stories.
Tribune has had a paper in New York called AM New York for the last several years that is a free paper given away on the subways that has virtually no staff. And it has a circulation of over 500,000 today, slightly below the Daily News and the New York Post, and has never made any money.
You know, I think. Go ahead.
Yeah.
Two questions. First, why is it such a problem for newspapers to monetize the internet when nobody else has a problem with it? It seems to me if you had the best writers on your staff and who wrote the best articles about anything and everything, that you would be able to get people to subscribe to your online if they were so inclined. And my second question is, did the newspaper industry freak out when TV news became popular back in the day?
The answer is yes. Newspapers were freaked out by radio. They were freaked out by TV. And some people say that the advent of the internet is just another one of these waves, and newspapers will adjust. I don't believe that. I think that this is a whole different level of challenge from those previous ones. I hope I'm wrong about that. But newspapers are having a high rate of growth on their websites financially, but the relative number is still pretty small. I don't know what the average is, but I think it's maybe 8 or 9% of their total revenues are from their website. And Norm knows a lot more. Norm can add to what I say and correct my errors, but they're growing at maybe 20%. They were growing at 30 or 40%. Now it's slowing. The growth is slowing down, and meanwhile the print side of the business is not doing so well. And there are some worrisome aspects of the type of business they do on the web. One of them is that a lot of it is so-called upgrades of classified ads, where if you sell a person a classified ad, you also say, well, put it on the web for another X amount of money. And the newspaper classified ad business is eroding, so that's not necessarily a good long-term bet. But there have been some projections as to how long President Trends will have to go before newspapers are able to sustain their news gathering staffs that they now have. How long it will take, and I don't know what the latest projections are, but it's not very encouraging.
Just a question to both of you along those lines. Now, when do people have time to read it? Are there any numbers that suggest that a metropolitan city with significant commuter public transit ridership has higher circulation than cities that don't?
It's changing very quickly. There were lots of photographs from as recent as 10 years ago of Metro North, where in the morning you'd see everybody with their head behind a newspaper, and now they're watching Desperate Housewives on their iPods. There are alternate sources of amusement to kill that hour getting from home to office.
I rode that train for 20
yeah.
years. I treasured that hour. 3 papers
Yeah.
that hour.
Yeah. Well, you're an old guy, Bruce. What can I say? And to come back to your question, first of all, on newspapers, I would say that the afternoon paper was pretty much killed off by TV and by the 6 o'clock by network news. Also complicated by delivery problems of getting it from the printing plant, to the home with increased traffic congestion and so forth. Radio took away some of the immediacy, and it may have pushed newspapers more toward analysis rather than just bulletin news, but was, I think, in many ways less of a competitive threat. The internet is competitive from a content perspective for a whole number of reasons, including the fact that, if you will, the model for newspapers and radio and TV has been a one-to-many model where an editor or a journalist tells a large number of people what's important and a hierarchy of values, and the net enables the individual to determine sort of what's important, where to go, what to look for information, and so forth. With regard to the question of monetization for newspapers, I think particularly in small communities, newspapers have a pretty good opportunity to do well, but it will be essentially advertising driven, just as radio and television essentially began with what the consumer perceived of as free information, advertiser supported but not subscription. I mean, HBO is the exception in terms of something you pay for on television. The internet model is one where people don't pay for content. The Wall Street Journal is an exception to that, and I can make the argument that it's a bad business model, even though they have 1 million subscribers paying an average of $65 a year for it. The big problem, I think, as John suggested, is, if you will, that competition has returned, and so the kinds of 30% margins that newspapers enjoyed in print, you're not going to see online. Google, at some level, redefines the notion of what news is, and that's both nationally and locally. This is just anecdotal, and you should be cautious about anecdotes, but I recently moved to a smaller apartment in New York, and I wanted to give away books. And I guess at some point in the past I would have looked to the New York Times archives to try to find a story, or go to the Yellow Pages to see if I could find a way to get rid of these books. And I just went to Google and typed in "Giveaway Books New York," and in 2 seconds I had a half dozen examples, including a place 4 blocks away, that picked up. And you don't think of that as local journalism, but in fact that would have been, probably that story was written sometime in the last 6 years in the New York Times. But this was current, it was up to date, it had a Google map that showed me where these places were, and that was service journalism that was pretty hard to replicate. Interestingly, a former colleague of John's named Hillary Schneider, who was at the Baltimore Sun, I think she overlapped with you,
she did,
as publisher, then went to Knight Ridder in San Jose, and when it was bought by McClatchy, went to Yahoo, where she now heads something called the Newspaper Consortium, and they have done deals with close to 300 newspapers on sharing ad revenues from joint ad sales. And I think a lot of newspapers have found that they need a place like a Yahoo to organize a lot of their ad sale, because it's just too hard for them to develop the technology on their own to do it. Newspapers can monetize online. They just can't monetize at the kind of margins that they've historically had in a monopoly position in print.
Well, one added thought on that, and that is that the advent of the search reader as opposed to the kind of subscription reader. Many of the readers that newspapers get online come from Google or Yahoo, people who put in a search and they find a story that they want, and they visit your newspaper website, read that story, and leave in 20 seconds. They are zero value to an advertiser. And the whole idea of a newspaper has been changed to the search reader, because the search reader really isn't interested in your newspaper. They're just interested in maybe one story which you and maybe 2 or 3 other papers have, and they're going to go to yours, they're going to go to the other one, they're going to go to the other one, they're going to go away. But they're not, we lovingly assemble this package of stuff that has comics and page 1 stories and book reviews and all that sort of thing. But for purposes of the web and the search reader, it's all shredded and separated and goes off in pieces to people, just the way the albums have been done on iTunes or and when you download music. And that, in turn, means that the audience for advertising is really not as effective, an advertising audience nowhere near as effective as the advertising that goes into the print edition.
Curious how many of you here read a daily newspaper in print. Wow, that's impressive. Surprising. And online?
Where's the phone? I want to call my broker and buy.
Right. Yes.
I don't know. Do you guys know who owns Craigslist? Like, what about trying to, I don't know if anyone knows who owns Craigslist, but
Yeah.
Craig. Like, what about, like, I don't know, doing some sort of deal or, like, getting involved into the web in a way that you could monetize it and tie it to your newspaper?
Sure. Well, Tribune has, well, Craigslist actually is owned by a guy, Craig Newmark, and he's got a few backers, and he now charges a few employment agencies, but in general, he's the worst of all kinds of people for traditional businesses because profit has not been his primary motive. It's a little bit like Jimmy Wales with Wikipedia and so forth. Tribune is the largest owner of something called Career Builder, which is an online employment agency that is linked to its newspapers as well as those of McClatchy and Gannett. They have another news organization called, I think, is theirs Auto Trader or another? They have an automotive one as well.
Mm-hmm. Cars.com, they have a stake in that.
Cars.com, and then they've got Topics, which is a news organization. And all of these things are okay. Career Builder and Monster are probably the two largest employment ones now. So they are, newspapers have woken up on a lot of these things. And if you look at some of the best websites now, you'll see video, you'll see podcasts and so forth. It's just that, as John suggests, I think you basically just have so many options in terms of what you're going to use as your home page, what you're going to go to for information, that you just don't have the kind of pricing power that you had as a monopoly in print. And that can be very healthy for consumers. It just means that the business model is really different. And the casualty, I think, in all of this is, which is maybe something we get into a little bit later, but the casualty in many ways is a kind of journalism that, if you will, the advertiser supported, the reader didn't necessarily want, but that I think you could argue is very much in the public interest. I mean, the Washington Post a few months ago did a 4-part series, 17,000 words, on IEDs, these roadside bombs in Iraq that were killing and maiming American troops. I know that less than 0.5% of the Washington Post readership read that series. I mean, it was impossible to read. It was brilliantly done, and it was deserving of a Pulitzer Prize. I don't think it won one, but it was just a magnificent piece of journalism. No business-driven publication would have killed that many trees to run that kind of series. And so I think from society's point of view, the question of how you fund that kind of journalism and how you find the audience for it is one of the things that a lot of us are spending a lot of time thinking about. Yes?
Well, if it used to be where you had to buy the paper and you had to buy the whole thing and just to read the 2 or 3 things that you were interested in, why not, instead of having one massive paper that's 30 pages, why not have the Tribune sports page for the people that are interested in sports and the Tribune news page, business page, whatever, and then if it was online, then you could have some sort of pricing deal where you could say, all right, if you want to subscribe to Tribune Sports and Tribune Business, it'll cost you 20 cents a week.
Yeah, micropay is micropay, I think, has tremendous potential, especially for people who have audiences outside their geographic area. I mean, you know, there are a whole bunch of people who are fanatics about Florida football who don't live in Gainesville and would love to read the Gainesville coverage. I mean, I had a colleague who was chief executive of Time Inc. living up in Manhattan and who was the world's biggest Auburn football fan. And I mean, he was willing to pay a lot of money just to know what high school players were going to, on letter day, sign for Auburn. That was worth a lot of money to him. And I think services will develop for that kind of thing. I mean, if you think about the New York Times website, there is without doubt a global audience of people who value the quality of that journalism and at a penny a page would probably think that's a pretty good deal. And yet that model has not yet developed to a point where you would think, just as there are prepaid phone cards, you would be able to have, you know, a prepaid way to get content. But at this point, we're just not there yet. I think this is exactly the kind of stuff that we're going to be seeing, though.
Do you think if you take away the bundled pricing, it gets a lot more inefficient for a business to operate?
Yeah.
Just like because you're going to be trying to administer to so many different audiences that there's going to be naturally parts of different businesses that are going to specialize in like the Gainesville sports, and and it just won't be able to. You won't be able to package the whole deal as well, and price it as efficiently.
Yeah, I'm guessing that the folks at Google with their algorithms can figure out how to address that. I think the more likely possibility is that there will be, you know, you would think at penny a page there wouldn't be pricing competition, but that there will be bloggers who would be happy to, you know, give that content away. There will be people for whom there'll be an ad model that will compete with it. Right now, part of the problem with the ad models is that there's so many different ways you think you're buying eyeballs that it's very hard to know what's efficient and what works and what doesn't. And I think that's, you know, we're still, I mean, when I read that General Motors is going to transfer half of its ad budget to internet advertising, I don't think there's enough inventory out there of, you know, to reach their customers, but they seem to think there is. So this is all very new stuff at this point. I don't think anybody's got those answers, but that's a really good question.
This is probably geared more towards Mr. Carroll, but with the rise of blogging and other forms of civic journalism, how do you think this affects like journalistic trends? Do you think these are better for pure journalism or detrimental? Does that, I mean, stand alone from
Can I get some more water?
business?
Well, I think that the rise of citizen journalism and blogging is, on balance, a great thing. I mean, if you believe in First Amendment, you believe in free press and free speech, this is just an explosion of free press and free speech. And it's admitted millions of people to the national conversation who previously had been barred from it. And bloggers have contributed a lot to the national discussion. They are good critics. They've been very good at keeping the mainstream media honest. You know, mainstream media does something wrong, bloggers are all over it. They are good at, and one way they do that is they'll swarm. For example, when ABC.com originally broke the story about Senator Strom Thurmond, or Senator Trent Lott at Strom Thurmond's 100th birthday, kind of endorsing what Strom Thurmond did in the late 40s with the Dixiecrat Party. And it was basically quite a racist operation that he was a leader of. And, you know, ABC.com broke that and then left it, and the mainstream media didn't touch it. The bloggers swarmed on that story, and some of them dug up the history of the Dixiecrats and what they really stood for. You know, they didn't want lynch laws. They didn't, you know, it was a really virulently racist operation. And so after a period of time with the blogosphere swarming, the mainstream media got back on the story and went in for the kill, and Trent Lott was chastened for it. Yeah. So they play a very good role in that. But blogging is a tough business. I had a blogger, a very well-known blogger from the West Coast, and I invited him to speak to my class at Harvard. And he was fretting because if he took a transcontinental flight, he would be away from the keyboard so long that his audience would start to dissipate. I mean, frequency is one of the things you've got to do on a blog to keep people coming to it. And, you know, you don't make very much money on a blog. You also, another of the imperatives of a blog is you've got to be kind of an extremist. If you're a reasoned, middle-of-the-road people, you will not have you won't have an audience. So the blogosphere, the loneliest part of the blogosphere is the middle of the road. The thing that really worries me about the blogosphere is that it is not a good business, and therefore it doesn't have many reporters. They don't have the money to have reporters. So you have a certain national supply of reporters, nearly all of whom are working for the old mainstream media. And the mainstream media are getting rid of their reporters. And no part of the new media is replacing them. Now I'm talking about general reporters. There are certain niches that have reporters. But the people who are covering the war in Iraq and people who are covering the main issues of the day nationally, there are nearly all the reporters are employed by the mainstream media. So I'm concerned that we're not going to have as many people out there turning over rocks, looking at things as professionals. Now the bloggers do some turning over of rocks, and there's some, you know, we are getting more information in some ways. One example is this woman, I think it was a woman, who broke the story about what Barack Obama said about the bitter people in the small towns of Pennsylvania clinging to their guns and their religion. That was a woman, she was kind of a hybrid journalist. She was actually an Obama supporter who'd paid money to be at a fundraiser and was in there, and she heard this said. She thought about it for a few days, and then she put it up. And I think she did the right, as a journalist, she certainly did the right thing. We're better off knowing that he said that than not knowing. But the blogosphere has, in some ways, not lived up to the hopes. You know, when it first became a phenomenon, the bloggers were really sort of singing "Ding Dong, the Witch is Dead." We're taking over. We are the media. In fact, I think that's the name of a book by a citizen journalist. We are the media. And the mainstream media are going to die, and they deserve it. Now I think the bloggers are less heady about it. They're not, and they at the same time they criticize the mainstream media. They deeply rely on the mainstream media to dig up the facts.
It's an interesting hybrid in Korea called Oh My News. I don't know if any of you have heard about it or seen it. Oh My News has 60,000 citizen journalists who have signed up with them as accredited journalists who basically, each of them covers their own block. They don't write every day. Some of them write once a month, some of them once a week or so, and then they've got about 30 editors who read these submissions from Oh My News and decide whether to put them up or not. So there's a filter before it goes up online. It's an online newspaper. It's not a print paper. But they then have decided they had to hire 30 full-time journalists to cover national politics because the citizen journalists just either brought so many biases with them or just were not able to do it. And now they have two editorial staffs, one to edit the citizen journalists and one to edit the professional journalists, and they tend to fight with each other quite often about sort of who gets the prominence and so forth. But it's an interesting experiment, unlike anything that I've seen anyplace else in terms of that number of people actually writing for one organized publication.
Is the appearance, and I see it on the New York Times, I can't tell you when it started, you guys probably know, of putting news analysis on the front page of the first section. Was that driven by the blogosphere?
I think it's been going on longer than that. And I think it was driven to some extent by the electronic media before the internet, which, you know, newspapers a long time ago were your first source of news. The first time you heard about a subject, you heard about it in the newspaper. And then along came radio, so people would hear about it. And then the newspaper had to give them something beyond just sort of the headline as to what the story's about. TV made it even more so that news analysis and more in-depth treatment was the role that the good newspapers were forced into.
Yeah, that's true.
I think that we're going to now move on to part two. I think that everyone has a good background on what the Tribune Company was like in the past, and part two is going to focus on the future of the Tribune Company as well as Sam Zell. And I think that we've already touched on it a little bit, but I think that they have some more insight and input that they could give to all of us so we can have more questions.
Well, I don't think we quite know the condition. Well, first of all, Sam Zell. It's worth. I don't know how much background you all have on Sam Zell. He is an interesting character. He, I would say, is a libertarian who is very conservative in his economic policies, quite liberal in his social policies. Drives a Harley. I don't know if is still a doper or not, but certainly for years was known. Has a house, lives in Chicago, but thought himself a perfect guy to own Tribune because he also has a house in Malibu, and was in the colony in Malibu. Was known as a doper driving his Harley there. He hates Hillary Clinton for reasons that I've never quite fully understood, but probably because Clinton was able to do things in the White House that Sam wishes he had done himself. I'm not sure. That was always sort of my impression. He is a very iconoclastic character. He creates these incredibly ornate music boxes that he gets handmade every year, which have him singing the lyrics that he writes himself to the tune of some rock and roll song with his economic forecast for the coming year that he sends out to people. He thinks of himself as irreverent. He thinks of himself as a change agent. He thinks of himself as being incredibly smart, and not unlike certain kinds of people who have amassed wealth in one area, thinks of himself as therefore omniscient about lots of other things. I remember my early days as a reporter for the Wall Street Journal, I covered energy, and I interviewed a very wealthy oil man named H.L. Hunt in 1968. And basically H.L. Hunt was rich because there was, he was, as they used to say, a guy who sort of woke up on third base and thought he'd hit a triple. I mean, there was oil in his backyard, and so he was a genius about politics, and he would lecture people about the state of America because he had oil in his backyard. Sam is very different, but Sam has made a ton of money in different businesses, and he has bought things that other people thought were absolutely dead and turned them around. He bought a barge company, and he knew nothing about the barge business, and he cut expenses, streamlined, made a fortune with it. He was particularly successful in real estate, and he sold at the top of the market to a private equity firm, the Blackstone Group, leaving him, I guess, with personal profits of several $billions. if you want to know more about him, Connie Bruck wrote the definitive profile of him in the New Yorker last year. It's the best piece I've ever read on Sam Zell, and it really captures him quite wonderfully. Zell, that we were all looking at this thing, trying to figure out how to make a bid, and frankly, I didn't meet anybody in private equity who could get over about $30 a share, which was profoundly distressing to the sellers. There were a couple individual bidders. Eli Broad, a very wealthy man in Los Angeles who'd made most of his money. He'd started out the Kaufman and Broad home building company, now called K&B, but had then migrated into insurance, had built a company called Sun Insurance that ended up being sold to AIG. He's been said to be worth $5 to $6 billion. He got very interested, first just in the LA Times, and then he teamed up with a guy named Ron Burkle, who runs a private equity firm called Ukaipa, and they put a bid in for the whole company at about 33 or 34. What Zell was able to do is to use an ESOP, an employee stock ownership plan, and ESOPs are restricted really to individuals. A private equity firm couldn't use one, a publicly held company couldn't use one. You have to have, I think, fewer than 100 employees to use an ESOP, and with this, basically what he was able to do is put up very little of his own money and end up sticking the employees of Tribune with ownership of the company, so that at this point, the structure of the Tribune company is one where Sam Zell has, I think, $315 million of his own money invested in Tribune, and then there's about $12.4 billion of debt associated with that very small amount of equity.
It's kind of small to read, but you see the red blocks are what he owns, and the yellows the employees. Right.
Okay, 11.2 you've got. So $315 million seems like a lot of money to most of us, but from Sam's perspective, it's a relatively small bet in that if it doesn't work, he can walk away from it and still, he won't have to fly first class. He can still use his plane. He'll be fine. And he was able to fashion a bid that essentially paid out a lot of the employees who had stock in Tribune, and then create this new company where the employees are essentially the holders of the debt. It is...
What, are they protected by a corporate shield?
Yes. Yes. Yeah, in terms of...
So if the whole thing tips over, they're not on the hook for their...
They're not personally liable, that's correct. That's correct. It's an S corporation. But he has the voting control, and he has the right under certain conditions to buy up to 40% of the stock in the company. He does. But if you're a manager, but part of the problem is that I haven't seen the exact figures, but the estimates are that this year his interest payments on that debt are going to be somewhere around $1 billion, and the cash flow from these various companies is maybe going to be $1.1 billion or less. And if you're a manager, that just gives you very little room to operate. I mean, that's as tough as anything that I've seen in terms of a big enterprise. Secondly, he has some very big payments due that he has to get either refinanced or he goes into default. He had hoped to sell the Cubs, but he wanted to sell the Cubs, if I'm right, but he wanted to separate out the cable deal from the team. He was unable to get that transaction done, and that's why he's looking to sell Newsday, which is the one newspaper where he might actually be able to get a bidding process going, because Rupert Murdoch, who owns the New York Post, Mort Zuckerman, who owns the Daily News, Jared Kushner, who owns the New York Observer and a lot of real estate in New York, have all expressed some interest. I think Cablevision dropped out, which would also...
It's an interesting sidelight to what Norm just said, having grown up in Milwaukee and being a baseball fan. How many of you have ever been to Wrigley Field? Yeah. When I grew up, there were many games where when somebody got a base hit, even on the radio, the sound of the bat hitting the ball echoed around Wrigley Field. The place was empty. Just empty. And now it's become a Chicago institution.
Yeah.
And John talked about culture 3-4 years ago, and if you've been there, over on Waveland Avenue, just outside of left field, there are apartment buildings that have grandstands on the roof. And the people that own the apartment buildings charge admission and sell seats. The Tribune company wanted to put a wall up to block the view. And the public, I'm sure the bloggers, crushed him with that. Now Zell is talking about selling the name and renaming Wrigley Field. I mean, there's going to be a riot on the north side of Chicago if he does that.
Well, Sam has a few... Look, Sam is a very smart guy, and some of the things he is saying make sense, although I think John has a better report from the field about how they sound to journalists. Journalists are going to be a bit skeptical, some would say cynical, and, you know, when you start getting sort of little smiley emails that say today is the first day of the rest of your life, you tend to, you know, not take them too seriously and so forth. He has been giving speeches around the country to journalists, and maybe you can talk a little bit about some of those, but his basic problem is that I think he came in believing, as many people who are not in the newspaper business believe, that this is just a cyclical downturn, that he is buying at the bottom, and that the people who were running Tribune there was too many layers of management. They were no good. If I just decentralize and let good ideas bubble up from the top, I can make this a lean, mean machine and I'll make a lot of money. And that if it doesn't happen, my downside isn't all that great. I think what he's finding out coming in is that Tribune may have been flabby, may have had too many layers of management, but there aren't all kinds of brilliant ideas down there that overnight solve his debt problem. And the difficulty is that if you start selling off the pieces, it doesn't add up. I mean, a number of us did some of the parts analysis when we were trying to put together bids for Tribune, and that's why we couldn't get over $30 a share. So that suggests to me, you know, he may get lucky on something. There are a lot of hidden assets there. He may find that you can sell printing presses and lease them back, that the food channel he may get a great break on, that because of the overall economy, the Fed is going to continue to push down rates and he can renegotiate his debt at lower rates. You could see all that stuff happening, but over time, this is a pretty rough deal he's got. He's been doing some very unconventional things. He's been bringing in radio people to take over some of the newspaper operations, and his rationale, as I've heard it, is, well, radio had to confront television, so these people know what to do in the face of adversity. Well, radio confronted television 50 years ago, and I don't think it tells you very much about confronting the internet. So, you know, it's early days. It took him a year to close the deal. The deal only closed at the end of December, and it may not be fair in mid-April to be making judgments about whether it's going to be a success or not. But so far, at least, I think it is a more difficult market than he thought it was going to be. The ad market is a whole lot rougher. Lord knows the housing market is tougher than anticipated, which clearly has an impact on some advertising in a lot of his key papers. And
take the other side of that for a second. If he can get past the paying off the balloons, whatever balloons come due on debt, and extend the maturities of the other debts. He's in a very low interest rate environment right now generally.
And he doesn't have to pay any taxes if he ever gets profitable.
You could almost argue that he becomes a deep pocket buyer without any of the pressures that you and your partners face at a private equity shop where, yeah, you want to buy low and sell high, but you also, at least, might have a clock ticking.
We do. Private equity, one of the problems with private equity is, hedge funds want to get a profit in 3 months. That's long-term investing for them. Private equity tends to be looking 5 to 6 years out, and so whenever a private equity firm looks at a deal, you not only look at how much do I have to pay for it, but what is the exit multiple? What can I sell it for? And Sam does not have that pressure on him. You're absolutely right. I'd be interested what you're hearing from your former chums at the LA Times and elsewhere as to how the message is going down, be it his April Fool's website or his speeches explaining why he thinks strip club advertising is good for the paper and so forth.
He's really a different type of owner from any I've ever seen. And when he came in, he said he openly disparaged his predecessors, and everybody in the company, business, news, and so on, would certainly felt he was right about that. But he said that they had been trying to make it by cost cutting, and that he didn't believe in that. He thought that increasing revenue was crucial, and that was the way things were going to be. Then, within a month or so of his arrival, a month or two, he discovered that revenues were very much less than he thought they were going to be. I mean, it was already going sour, and there have been considerable cuts since then. Cost cutting continues just the way it did under the old crowd, and people on the inside were really not very surprised by this, but because they're accustomed to this, but they were disappointed because he had indicated it wouldn't be that way. I think there's every reason to believe, as Norm indicated, that Zell, although he's obviously a very smart guy, didn't grasp the nature of the changed nature of the business model of newspapers, and the way we used to have monopoly that was allowed us to operate the way we traditionally have, and that now that is gone, and the web has really torpedoed our business. I think he understands that now, probably, but it's a painful lesson for him. In terms of the messages that the staff received, it's kind of interesting. Sam sends frequent messages by email to all of the staff members, which he addresses, I think, as partners, because, of course, they're involuntary owners of the company. And I will tell you, we journalists tend to look at how people write, how people express themselves, the clarity of thought and so on, and I'd give him about a 10. I mean, his emails, they're breezy, they're conversational, but they make sense, they're to the point, and he comes across as more intelligent than his predecessors, just based on the communications one gets as an employee. And of course, I'm not in the company, but these things get forwarded. I get barraged with them.
Are you suggesting that could elicit an uptick in performance that prior management suppressed?
No, I don't think it'll change anything.
Okay.
I'm just using it as a way of judging the caliber of the man. You know what? And I'm convinced he's smart, and he's not only smart with numbers; he's verbally smart. Now he is, as Norm mentioned, he's hired people, some top executives very recently from the radio business, including one guy who's the innovation chief named Abrams, and he sends things 2 or 3 times a week to the entire staff that is just New Age gibberish. I mean, he doesn't even use whole sentences. It's. I wish I brought one to read to you. He's either wildly smarter than I am, or he's a fraud. And I'm not going to pass judgment yet, but I'm pretty sure I know which it is. And have you been reading this stuff, Norm?
Yeah, you sent it to me.
It's unlike the messages that journalists have received. You know, it's funny. Journalism is a culture. We're very self-absorbed.
Neurotic.
You know, we're neurotic. And there are ways to speak to journalists that they will really, really connect with and like, and they will understand it. And this is almost the opposite, because they tend to be skeptical, and they tend to be able to take a piece of communication like this innovation chief is sending out and just take it apart. I mean, you know, analyze what did he really say in that sentence, and the answer is nothing. But I think there's a dogma in the business world that, I'm not trained in business, but I think there is a dogma that one of the things you should do as a CEO is to unfetter your staff, to unleash them, and to get the creativity coming from all levels of the company, not just a top-down thing. And I'm basically in favor of that. But this is not the first CEO we've had who has come in and asked journalists to fix their financial problems. And journalists don't know how to do that. Journalists are very, very absorbed in getting stories every day, and they really know what they're doing as far as that is concerned. But they don't understand. I bet you there aren't 10 journalists in the whole company who understand this S-corporation structure. I don't. I mean, it's a mystery to me. I've got sort of the broad outlines. I could talk about it for 2 minutes, but I probably would not be able to talk about it for 3 minutes. And they're not going to be able to fix this. And no amount of exhorting them to be creative will do it. Now, they could do some fixes in the journalism part of the company. But as Norm says, the problem is not that. The problem is a revenue problem, basically. And journalists don't sell ads. They don't know how to get revenue. They never have in their lives. In fact, they are by temperament and by ethical standards totally separate from the revenue-generating part of the company. And they want it that way. So that's kind of the way it looks from the point of view of the employees. The tension in the company that's increasing is the fact that Zell incurred this $11.2 billion of debt on behalf of the employees, and as Norm said, he cut it very close. Revenues are falling, and the payments are coming due, and so he's got to do some fancy dancing, probably sale of assets just to keep afloat, much less to move forward. And he is, at the same time, kind of a showman, and he comes around and talks to the employees, talks to the staff, and is quite overbearing. And Norm gave a very good mini profile of this colorful character, but what you left out was that he's very profane. He is really pretty vile in the things that he says. And that doesn't go over too well either. Newsrooms tend to be pretty loose about that sort of thing. But when it's the CEO coming in and using the F word in your face and that sort of thing, that little of that goes a long way. So that's what it's like from the inside.
What's the profile of the debt holders? Who are Zell's lenders, that $11 billion?
It's all over the lot because there are different classes of it.
Some of it's public debt.
Some is public debt. Some of it is still held by banks who are unable to sell it. I think it is now trading as low as some of the more junior debt is trading, like at 60 cents on the dollar.
So could, rather than repay it, you could restructure a lot of it perhaps because some of those lenders are gasping themselves.
Correct.
And that may be the biggest thing on his mind right now.
It may very well be that there are a couple things that I think are on his mind, and this is why, while all of the journalistic focus is about what's he going to do with the papers and what's he going to do with the journalism and what's he going to do with the revenues, there may be a lot of financial play at work here. We were talking last night about the fact that one of the unanticipated things that's happening in the newspaper business is that last year consumption of newsprint in the United States fell 10.7%. That notwithstanding, newsprint prices are up 25% this year. And the reason for that is because the two biggest newsprint manufacturers in the world, Abitibi and Bowater, got Justice Department approval for a merger in November and promptly pulled 500,000 tons of production off the market. And there are now just 4 big newsprint manufacturers left in the U.S. and Canada, and they have effectively increased the price of newsprint in the spot market is now over $700 a ton. So even as newspapers are cutting back the width of their paper, cutting back on the amount of newsprint, the prices are really going up. And I have one friend in the business who is trying to structure a deal actually with Zell where he would go out and basically try to figure out a deal to pay to try to figure out a way to pay newsprint bills with some of this debt.
If Abitibi or Bowater are publicly traded bonds,
yes,
he could buy those bonds in the marketplace,
right,
and barter,
and try to barter for them,
and barter for his newsprint.
For his newsprint, right. Yeah, that Zell might try to go do that. So you might.
I wouldn't put it past Zell.
No.
To buy Citicorp debt,
right,
and barter that to cancel
some of his own, right. So you might.
There's a lot of big stuff going on here that could.
Yeah, I mean, we see some very strange things going on in the capital markets right now. And like John, I mean, I've been doing business news now for about 40 years, and I'm still scratching my head over it. For example, because of the freezing up of the credit markets, private equity has been unable to get banks to lend them money since last August. Yet the headlines of the last week has been how private equity is now buying stock in banks to make sure they have sufficient capital that they can start lending again. Now, that seems like a Ponzi game to me, but I don't understand the dynamics of that. So in that kind of environment, you might see that Sam Zell is far more involved in pursuing debt restructuring than he is running his business over the next 6 months.
Blackstone, I think TPG, and who was the third, $12 billion of debt back from Citigroup at about 80 cents on the dollar.
Correct.
Just going to hike their returns big time.
But it will also give enough capital to Citigroup, presumably, to start feeling confident enough to start lending to private equity to do deals again.
Well, that's certainly what they hope.
Yeah.
I'm not so sure.
I'm not either, but I'm just. So so what it means is that while most of us are focusing on things like circulation and advertising and is the newspaper any good and the internet, it may be that what Sam Zell is really focusing on is the bondholders, because Sam learned a lesson of business quite a while ago, which is that debtors sleep better than creditors.
You bet. He owes enough.
If you owes enough. If you owe enough, you sleep better than your creditors. So.
Just one comment on the financial question. In terms of renegotiating the debt that might involve lenders taking equity in the company, does he have much room there because he has so little voting control? Would he dilute himself out of power pretty quickly?
I think that's a real risk for him, absolutely. I don't know the answer to that.
Is there any other further questions on this topic? In the back?
I don't have this on this topic. This is a statement, half question.
Would you mind speaking up a little bit, please?
Just from some of the statements that you make. So I'm a self-absorbed journalist back here. I'm not a finance person, but I've been listening to what you were saying. I don't have a finance question, but more about the newspaper business in general. I have friends who work in papers here in the state, writers, other people who are tech people. They're both worried they're going to lose their jobs in the next year. What we see with the bloggers and self-appointed experts, that the internet has exploded, the shift from taking what is sold to you to deciding what you're going to buy, like, ownership and iTunes and all that kind of stuff, where people aren't reading the newspaper, they're lucky that their house got it in their iPhone. Do you even think newspapers will exist 30 years from now?
Let me edit that question a little bit. Do you want to get to one of them?
And as far as the
No, it's a great question. Yeah.
Is the public being served? Is this what they want to be served? Are they being served? They're getting what they want, more entertainment and real news. There's a lot of information out there, but how much of it is real news? I mean, we've seen that shift with TV, newspapers, and now we're seeing it again. So if you don't have these patriarchal, civic-minded families like the Grahams and people like that, and now the people who have billions and billions are only concerned about adding more billions to the pot, and not really so much about civic-minded knowledge. Hilton's just want to be on TV and not feel about society and add more to their billions. Where do you see this shifting? I mean, is there any room in our society for a print newspaper anymore? Do you see it just ending?
Well, let me have a crack at that. You've really raised several pretty difficult questions. The question of whether we will have print newspapers 30 years from now, I don't know. But and I don't think that's crucial. I mean, I don't care whether it's print or digital as long as the stuff's being covered and being read or absorbed on video or audio or whatever. And that it's being covered by large teams of professional journalists who are not just, I mean, I like the bloggers, but I think you need the big teams that are well-financed and can withstand a big lawsuit and so on. So I think that's the important thing. Let me interject a personal view, which is a very much a minority view in the business. I think that we made a mistake going to free content. Because the fact is, as in the advertising business, we're nothing special. We don't have much advantage over anybody else. The one really unique thing we produce is the journalism. And, you know, I don't think the entire tech world says the way of the web is free content. And I'm afraid that that could be a death sentence for large journalistic organizations. But I don't know if Norm thinks I'm off base here, but most people do. Most people. The newspaper business has cast its lot with the free content people, and it's not working out very well. And I don't know if there's a way to go back to that fork in the road and try something different, but something's got to give if we're going to have media along the lines of what we're accustomed to in 30 years. Now, you raised other questions about popular appetites, people, news coverage veering into the Britney Spears realm, and that's a whole other question that's, I think, quite important. The sheer amount of stuff that's available to keep you entertained and stimulated and interested that is not really journalism is, it's considerably more than it used to be a long time ago, and people are distracted by that and fulfilled by that, and they find news kind of backward and boring, so they don't absorb it that much. There's also trends within society that militate against journalism. There have been studies showing that people who are engaged in civic things, people who care about their community, people who are rooted, tend to be newspaper readers. And there's a lot of atomization of people within society now. There are books on this, like the book called Bowling Alone. There's a decreasing engagement in the larger cause and a greater engagement in me. And that doesn't help newspapers and other outfits that provide serious journalism. So those are a couple of thoughts on your question. I'm not sure. I don't think I touched all the parts of your question, but I touched a couple of them.
A few things, just echoing some of what John said, differences. I think we may very well see communities where newspapers decide maybe to come out 3 days a week instead of daily, or alternatively maybe just have a Sunday paper and not have a daily paper, maybe just have a website during the week. San Francisco Chronicle loses $1.3 million a week right now, largely because of Craigslist. You could imagine a business scenario that says, you cut your loss to zero if you close, but if you just came out with a Sunday paper, that might be a more viable business model. I haven't spoken to those folks, but I could imagine. I know that the New York Times has had those discussions and rejected it, but that it was a close call, if you will, from an economic point of view. They had good reasons in terms of their franchise for wanting to keep having a day, but that people have looked at the idea that we'll just go with the web during the week and just have a paper on weekends because that's the only time people have time to read anyway. And an increasing part of the newspaper business is this so-called FSI business, or freestanding inserts, all those, brochures from Target or whatever it is that you're getting. So it is not inconceivable to me that there might be a print product, but that it might not come out every day. I think a second thing is that...
One second, Norm, just to that point. Every morning now on Bloomberg and CNBC, the New York Times runs an ad pitching subscription. Subscription to the Friday, Saturday, Sunday paper only.
Right. Yeah, which to me seems to go against, if you will, the newspaper reading habit, which is what people have tried to inculcate for years. But it's a recognition that that's when people have time to read to read a paper.
It's also an extension, at least many younger people don't feel they have time to read the paper, but they'll read the Sunday paper.
Yeah.
And we used to, in one paper I worked at, go after them by trying to sell them a 3-day weekend subscription,
right,
which actually gets you more days out of a reader than you would otherwise get.
Sure. Second thing, I guess, is I'm a bit more sanguine about magazines than I am about newspapers. For one, magazines never had classified advertising to begin with, to lose. Secondly, never were publications of record and never were meant to be timely. So the idea that you look at a stack of newspapers that if you go away for a few days, the first thing you want to do is just throw them out and get them out of the house. A magazine can sit around for a while. For all of the decline of print, we actually, and newsstand has been very tough for news magazines. Time magazine, which as recently as 10 years ago was selling 225,000 copies a week, I think is now on newsstand, is now selling less than half that number, and it took its circulation down to 3.2 million from 4 million. That said, There are 2 million more magazines a week being sold on newsstand than there were 5 years ago, but it's almost all celebrity. People magazine last year made 7 times as much money as Time. In Style, a monthly, made more money than Fortune and Money combined. Us Magazine, In Touch, Star, together, I think, are selling OK. Can't forget OK. OK's business model pays for stories. So when Britney's sister became pregnant, Britney's mother got $1 million selling that exclusive story. It's about 2 million copies a week that are selling on newsstand that weren't selling before. But I think magazines will hang around a bit longer. And there are interesting niches that suggest some changes that are worth watching. For as difficult as it may be for some mainstream media and for some of the mass, and I mean, New York Times just laid off 110 people or something like that. The Economist circulation is up 50% in the last 5 years, and they are charging $110 a year for a subscription, while Time Magazine can't get more than 20. And it has more. Now, it's an elite audience. It's 1.1 million globally and only about 700,000 in the U.S., so it's just about a fifth the circulation of Time or Newsweek, but their circulation is up 50%. They have only recently started a website which puts some stories on it. But it's a global audience of like-minded people. I mean, I think that there is a global audience for quality publications. It's a question of how you reach that audience and how you monetize that. And I don't know that we've necessarily figured that out yet. But it is worth sort of keeping an eye on some of these counter trends. My own feeling is that if there's an industry that is even more antediluvian than newspapers, it would be the book industry. It's the last great 19th century industry. I wrote a book last year, and I handed my publisher a CD with my manuscript, and I asked them when they thought they would have it back, and they said it would be about 5 months, and I said, well, I understand that you need to develop a marketing plan and so forth, but why is this? And they said, well, we have to set the type. And I said, well, gee, I realize I come from magazines, and we have Quark, and we use Max, and I don't need some fancy font. I'm okay with Helvetica or Times New Roman or one of 300 different fonts that are available on either a Mac or a PC. And they said, no, you don't understand. We re-keystroke every word of your manuscript, despite the fact you gave us a CD, because many of our authors still give us manuscripts. And I found myself with each of the 3 edits of my book, I had to use a different colored pen for my corrections. So I think that there's an industry where technology might make a difference, and that, in fact, that 17,000-word investigative report on IEDs might be better sold on Amazon using a Kindle for, 99 cents than trying to figure out a way to make that make sense in the Washington Post. But these are early days, and we're still trying to figure this stuff out. I mean, it's hard to realize this, but the internet has been around less than 15 years. I mean, you think about that. Television was invented in 1923, and in 1938 nobody knew what the hell it was. I mean, in 1958 nobody was really sure what it was, and I mean, when you think about how quickly even now we've developed some big businesses of scale on a very new industry, you realize that it's very hard to imagine where this is going to go. But I'm actually fairly optimistic that out of this there will be opportunities for teams of journalists to do the kind of public service stuff that we need. But I don't think it's going to be I don't think there's going to be a daily print paper in 30 years. That would surprise me.
Can we revisit the paid content? I mean, I just re-upped my journal thing. I'm going to say, what do you think? You're at $65. I mean, who can't pay $65? I mean,
yeah, but if it's for free online, why would you? New York Times tried to have a premium service for its columns at $49 and gave up on it because people just didn't want it.
They threw in the towel too quickly, John?
They threw in the towel. No, they didn't throw in the towel too quickly on that initiative. One thing is that they were putting their opinion pieces online, and if there's one thing that the bloggers can give you and that the free online world can give you is opinion. So they're entering a crowded field and where everything is free. When I was trying to brainstorm this thing, I came up with a scheme which didn't lead to anything, but I still think it was better than what we've got now, and that was that it was an attempt to reclaim a little piece of our old monopoly and to institute paid content, and that was for a consortium of the 4 papers that cover national, foreign, and business news seriously, and for them to join together and to create a website that would in effect be a newsstand, just like a newsstand that sells 4 papers. And you could go on it and you could order any of the 4 papers or all of them or 3 or whatever you want. And but you would have to pay. And I think that if those 4 papers, the New York Times, Wall Street Journal, Washington Post, and LA Times, were paid, I think it would be a very popular product and people would have to have it. Millions and millions of people would have to have it. But these companies, there are certain practical objections to this. One is that these companies don't particularly like each other, don't particularly get along, and they all had plans going in other directions. I actually spoke with a few of them about it. And there's also certainly an antitrust restraint of trade question. I talked with a few lawyers. I think it's probably surmountable. But if those 4 big papers, which are by far the best sources of national, foreign, and financial news, could have taken a decisive move working together to establish a paid content model for the top level of journalism. In other words, establish a premium brand of journalism online, which would be in contrast to commodity journalism. I believe that it could have worked, and I think it's not obviously going to happen, particularly now that Rupert's in the game.
Did the breakup of the Washington Post, New York Times cooperative publication of the International Tribune tell us that's impossible, or was that just egos that broke that apart?
You know, they're friendly now. I mean, they profess to be friendly. Don Graham professes to be friendly with Arthur Sulzberger, even though he had a bitter parting of the ways.
Well, he's friendly because it was the best $70 million he ever got.
Yeah.
I don't know if you all know this story, but the New York Times and the Washington Post owned the Herald Tribune 50-50, and Arthur Sulzberger decided that this was hindering the global growth of the New York Times brand. And his initial idea was that if he owned the Herald Tribune 100%, he could actually change his name to the New York Times, and that together with the New York Times website, this would make the New York Times a global paper. And so he basically went to Don Graham, the head of the Washington Post, and said, I'm going to give you $70 million for your 50% interest in the Herald Tribune. If you don't take this deal, I will stop investing in the Herald Tribune completely and resurrect the international edition of the New York Times. And the Times had much more of a global interest than the the Washington Post, which is much more of an urban local paper. The Times had a national edition, so Graham was very upset about this. This was an ego thing. He too had an apartment in Paris, and but he grudgingly took the $70 million. Well, it turns out that the Herald Trib's readers didn't want something called the New York Times. Hello. And by the way, this business has lost over $20 million a year every year since the New York Times has owned it. So Graham can afford to be magnanimous about it with his good friend Arthur. He's very grateful for the $70 million. So, but I don't know if that goes to answer your question.
Was the question asked when I took a break that I didn't want anybody else to take? Is there a concept, the newspaper of record, and could this consortium become the newspaper of record globally? And does anyone care about a newspaper of record anymore, or are the IED articles just going to go unread? When we were all in college together, the New York Times every week had some monster 10,000-word article on something, reprinted presidential speeches, word for word. That's the journalism I remember.
But that stuff's all available online now.
Yeah.
You know, you may be right about this. The Journal, when Rupert Murdoch took over the Wall Street Journal, the first thing he said was, "I'm going to make the website free." And then he took a hard look at it, and his business people talked him out of it, and they're now still charging for it. And it's a close call. The economics of the Journal Online is that they have 1 million subscribers. They get $65 million a year in revenue. Part of that is a blended rate. A number of people who subscribe to the paper, I think for an extra $29 or something, get the online version as well. So it's not exactly clear how you allocate those fixed costs. And then they get about $75 million in ad revenue. Murdoch's presumption was that if he made it free, he could double the ad revenue and more than cover the loss of circulation revenue. What his people told him immediately was, well, one of the reasons we get $75 million in ad revenue is that the fact that this is paid content means that we can charge a higher cost per thousand, or CPM, than we could for free content, and that in fact the Journal's CPMs are higher than the New York Times's because it's a paid product. So you don't have to, you have to get $200 million in advertising to make up for the lost circ revenue. And that became a whole lot more difficult for him, and that's why he's decided, at least for now, to keep it a paid model. I think his long-term ambition is for size of audience, and he believes that size of audience is a better way to go than to have paid content. Again, the television model of being solely advertiser-supported without circulation revenue, I think, is one that most people on the internet think is going to go forward. My own feeling is that if those 4 newspapers did get together, one of 2 things might happen. One is there would then be pressure to say, well, why do we need 4 stories on that service? Why don't we just have one story instead of 4?
Except that if you view it as a newsstand model, they would be competing with each other.
Right.
And you wouldn't have to buy all 4 of them. You could buy one, and that would satisfy you if it was better than the other.
But again, you're going to have some expenses associated with this, you know, in terms of this charging model, and so your news is going to be a cost. So there might be some pressure to say, well, do we have to duplicate at least all of these things? The second thing is, if you're a CNN or if you're a Chicago Tribune or something like that, you could imagine saying, well, okay, here are these guys who want to charge you, but we've just done a deal with The Guardian or The Independent in London and with MSNBC, and we've got video as well as audio, and here's a product. And for most news, I mean, how much do you really need to know about that tsunami that just hit Thailand and so forth? I mean, if you look at the Google traffic, for instance, on Katrina, you would have thought that if not the New York Times, then at least the New Orleans Times-Picayune would have gotten heavy traffic, but an awful lot of users failed to distinguish between Agence France-Presse, the Associated Press, and the New York Times. I mean, it's very depressing to editors, but on most stories, people don't make those distinctions. I mean, if I asked you today which stories in the Gainesville paper were from the LA Times, the New York Times, and the Associated Press, I doubt that any of you were looking at it and sort of making that kind of distinction throughout the paper.
But there would be big constituencies for these things. For example, if you were in business in a serious way, you would have to have the Wall Street Journal and New York Times coverage, I think.
Not if you had Bloomberg and Reuters. I don't think you would.
Mm-hmm.
But then, you know, they would try to charge you as well. I mean, I think, look, Google is in a great business. If you don't have to pay for your raw material and you don't have to pay for your distribution, that's a pretty good deal. And we all wish we had businesses that were like that. And I think if you could work, you know, I think I'd far rather try to work out a deal with them where they paid me for my content, I think, than try to create this kind of newsstand. But you're right that, you know, right now, reading quality newspapers, that's a niche audience. I mean,
yeah.
We're not talking about big...
But it's a high demographic.
But it's a high demographic that advertisers presumably would want to reach.
Yeah, yeah.
You're right.
We let these people go at 35 after.
Yeah.
So I want to
okay.
say a couple of
should,
words.
Good. Great.
Out of gas.
And we
here.
should probably think about getting to an airport as well, so thank you.
You can hang around a couple of minutes. Yeah, I got
Yeah.
it.
Oh, you got one?
Yeah. This is the Miami Herald, where I live, and this is what my children read, who are in their 30s and 20s, the 5-Minute Herald. I don't know if that can be part of the model as well. Just quickly, a couple of thoughts for you all. And the Capitalism course has tried to bring together how markets work and how the marketplace is, in my view, the best pricer of assets. The things that the students that are taking that course are familiar with. But a couple of things. We've heard about it this morning with regard to business models. And people who aren't willing to change, I don't care whether it's newspapers or on pork bellies or whatever it is. My son likes to tell the story of the, whether it was true or not, a meeting of the chancellor at Stanford years ago, and the deans of all the schools went to this meeting every week. And they went through the list of all their problems, and the guy says, any other issues? And the head of the engineering school, the dean, said, yeah, we got a big issue. The chancellor goes, what's that? He said, we don't have any bandwidth on campus. It's gone. Yeah, you know, the chancellor doesn't even know what bandwidth is. I'm not saying I do. But he had the brains to say, where did it go? And the dean of engineering said, it all went into one dorm, where the founders of Google were living as sophomores in college. And I love Google as much as you do. The one thing I do know, and will say with certainty in here, is while they're making millions right now, there are sleep-deprived people your age all over the globe looking to blow their business model to smithereens. And that's what makes business and the world exciting to me, and hopefully to all of you. I think if anything comes out of the Tribune case study, and I've been in Wall Street a long time, this growth by acquisition is something I'm always leery when I hear about it. All the words we heard, synergies, we're going to cross-sell, all this stuff. I call these things hothouse mergers. You lock two CEOs in a country office in Stamford, Connecticut over Labor Day weekend, because they never get hatched except over 3-day weekends. And the CEOs are mostly men, a few women, but they're getting called by their spouse, hey, it's Saturday, it's Sunday, we got to go to a picnic with the Carrolls, the Pearlstines, what the hell is going on? By Monday morning, and the AC's off over the weekend, You know, somebody, people say, all right, screw it, we'll buy them. We heard about the Excel spreadsheet analysis. It is entirely true. The cost cutting, I'm a big culture guy, and I don't think you have to look any farther than Citigroup today, which I call a cultural bouillabaisse. There is no culture at Citi other than we grow by acquisition. I've been to off-sites. Are you a Citi guy? You a Smith Barney person? You a Solomon Brothers lady? What are you? And people cluster and don't talk to one another. It's no wonder to me that Citigroup right now isn't working. My students have heard this a lot. Capitalism has a very hard edge. I said recently on television that Bear Stearns was sacrificed on the altar of capitalism. And indeed it was. And if nothing else, it got rumor mongered out of business. That's the world in which you got to live today. The forces of supply and demand will price assets better than these two guys, better than politicians, better than students, better than Dr. Brown can model it. Supply and demand is everything. And if you've been in the securities business, I learned the hard way. It was always easier. It might still have been uncomfortable. It was always easier for me to be short something. Be short some bonds, short some stocks, short some futures, because I could always go bid for them if I had the cash in my pocket. But if I was long something and I paid too much for it, then I was reduced to being a waiter walking around with a tray. Please take some of these from me. And the buyers, you couldn't find the buyers. Don't ever underestimate the power of supply and demand. You're hearing a lot now about regulation, re-regulation, more regulation in financial services. I mean, all industries have been through this. John talked about deregulation. We're going to get some more laws. We're going to get some new housing laws. But we're always fixing last week's problem. And I'm telling you, the same people that are going without sleep trying to unseat Google are already way ahead of whatever Congress is going to produce on housing. It will not take long for the brightest minds of Wall Street to figure out how to drill down your mortgage and restructure it electronically, even though it's wrapped in a security owned by the Fire and Police Pension Fund in Auckland, New Zealand. That's part of what's holding all this up right now. That's going to get fixed. And the laws, it'll be way ahead of whatever laws we get that are passed by Congress. You can bet that ranch on labor and capital are always and always will be uneasy bedfellows. We're seeing it in the Midwest, and your heart has to go out to anyone you know who was raised in a family that worked in the auto business or the tire business or any of the big Midwest Rust Belt industries, or were working in printing plants, and newspapers, etc. And they need help. And we talk about this a lot in the class. And the politicians love that kind of stuff. But take it to the bank. Those jobs aren't coming back in Elyria, Ohio. They just aren't in that form. We need as a society somehow to gather ourselves to figure out whether it's tax incentive, re-education, moving allowances. We've got to help these people, but help them in a way that works for them rather than just playing to their victimization. And capitalism, it makes that very tough to do. It's certainly come out in here that capitalism and public policy are often at odds as well. I'm a big newspaper reader. I want those layers of review and editorship, and I could care less about what some blogger thinks about some subject. Interesting that he or she has an opinion. It hasn't been vetted. It hasn't been whatever. And maybe it doesn't need to be. It does for me. I want it to be strained, reviewed. So I hope that you can keep pushing that model. I've been on enough boards. Norm's a student of corporate governance. You know, any public company, return to shareholders, maximizing shareholder value, that's what it's all about. But big corporations, many of them historically, whether it was the Times Mirror or Tribune or whatever, contributed to their local charities, did all kinds of stuff. There's always been a debate whether they do too much or not enough. And the last thing is the whole political arena. We have a great opportunity this year with a presidential election. We'll soon have 2 candidates, I suspect, rather than 3. And you're going to hear a lot over the summer and fall. As I've said in the class, listen carefully to their words. Don't buy into any of it till you go home and parse it. And if you're troubled by it, get a dictionary out or go online and get the real definition of the words you hear, particularly words like fair, which we've talked about a lot in class. But you're going to have a great chance to see this in action in the collision of the politician versus the business person. So with that, my last, as a lot of you know, I'm a big believer in being a learner. If you've learned nothing else today, you've learned that these 2 gentlemen didn't get where they were by not learning and relearning. And just on a personal note, thanking both of them for being here. To people like you, cultivate these kind of friendships. Years have passed when I haven't spoken to Norm or John. And then I see them or we get together somewhere. But the bond that was created in college, the trust, means a lot to me. I think it means a lot to these guys. And I just urge you to think about that as well. So, thanks very much.